The Bentley account. 2 years ago, I wanted a new car, a Bentley convertible. The price, $200,000. I had the money in my asset column. I could have purchased the car for cash. The problem with buying a $200,000 Bentley with cash is that the car is worth only $125,000 the moment I drive it off the lot. That is not a smart use of my cash. Instead of spend my cash, I called my stockbroker Tom and authorized him to convert some of my gold and silver shares into $200,000 cash. His job was to take the $200,000 and turn it into $450,000. The project was named the Bentley account. It took Tom about 8 months, but he finally called and said, "You can buy your Bentley." I then wrote a check and paid for the Bentley with the cash that had been created by my assets. The transaction looked like this. Starting balance sheet position. Ending balance sheet position. The reason I needed the account traded up to $450,000 is because the extra $50,000 was to offset the taxes on the capital gains and the commission that Tom made. At the end of the day, I had my Bentley, and I still had the original $200,000. If I had just paid cash for the Bentley, without trading the account, the ending balance sheet position would have looked like this. I would have lost my $200,000 in cash assets, i.e., gold and silver certificates, and I would have lost an additional $75,000 due to the instant depreciation when I drove the car off the lot. In the chapter on Financial IQ number 2, Protecting Your Money, I wrote about how good brokers can make you rich and bad brokers make excuses. The Bentley account is an example of a good broker making me rich and happy, allowing me to afford the luxuries of life. So, keep looking for a good broker if you don't already have one. Assets equals luxury liabilities. Liabilities. One of the benefits of being an author is that when I want a new liability, I first write a book, like this one, and the royalties from the book pay for the liability. The future transaction looks like this. At this point it might be beneficial to remind you what an asset and a liability are. In my book Rich Dad Poor Dad I defined them as simply as this: an asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. There is nothing wrong with enjoying liabilities, as long as you continue to pay yourself first and purchase them through the income generated by your assets. In the example above I used my assets to purchase my liability, and at the end of the day I still had my asset and my Bentley. Examples of other assets buying liabilities are shown in the diagram below. These are actual examples of how Kim and I use our desire for luxuries to make us richer, not poorer. As stated earlier, I do not believe in living below my means. I believe in first expanding my means and then enjoying life. A person with a low financial IQ only knows how to live below his or her means. In other words, cut expenses. If you do not give yourself the luxuries of life, why live life? Budget tip number 4, spend to get rich. When the going gets tough, most people cut back rather than spend. This is one reason why so many people fail to acquire and maintain wealth. For example, in the world of business, when a company's sales begin to drop, one of the first things the accountants do is cut back on spending. And one of the first things they cut back on is spending on advertising and promotion. With less advertising and promotion, sales drop, and the problem gets worse. One sign of high financial intelligence is knowing when to spend and when to cut back. When Kim and I realized we were in trouble, instead of allowing our bookkeeper Betty to cut back and pay bills first, we went into full-scale sales, marketing, and promotion. We spent time, money, and energy increasing our income. We did not cut back on expenses. In the workplace, there are many owners or managers who prey upon the weak, people who need their job and money. There are people who use the workers' weakness to make them weaker. For example, there are many big companies that cut your pay and/or increase your tasks to make you work harder. If you quit, they know that someone else will take your place. That is how the game is played. That was the way things were at Xerox. When I did well, instead of give me a raise, they cut my territory, increased my quota, and cut my pay. It was their way of making me be more productive. At first I got very angry. I wanted to quit, and I almost did. If not for my rich dad, I might have quit. Instead, Rich Dad pointed out to me that Xerox was training me in the ways of business. They were training me to do more with less. They were making me stronger. Once I saw the benefit to this way of business, I actually became a better business person. I learned to take the pressure and use it to my benefit. When Kim and I told Betty the bookkeeper to pay us first, before we paid our taxes and bills, it was our way of making us stronger, more viable for the world of business. Instead of crying, cringing, and paying when creditors called and threatened us, we used our creditors' energy to push us out the door to make more money. When people criticize and tell lies to tear me down, I use their negativity to make me more positive and determined to win. When problems arise, I use the problems to make myself smarter and to become bigger than the problem. Take it one day at a time. Budgeting is a very important process to learn and be smart at. Take the process one day at a time. Instead of fighting about money, Kim and I used the process to discuss and learn more about money and ourselves. Positive things did not happen overnight, but they did happen. If you will sincerely work at creating a budget surplus, your life will become richer. That is what budgeting is about, using what you have, even if what you have is no money, to make you better, stronger, and richer. How being poor can make you rich. Again, the definition of a budget is a plan for the coordination of resources and expenditures. You may notice this does not say a plan for the coordination of money. It's about the coordination of resources. A very important lesson from Rich Dad was that a financial problem is a resource, if you solve the problem. If you learn to take financial problems such as not enough money, a bad boss, or a mountain of debt, and use them as resources and opportunities to learn, you will slowly but surely create a budget surplus. The lesson my Rich Dad taught me about financial intelligence is really about being resourceful. He taught his son and me to be resourceful and turn problems into opportunities. He said, "When I was a kid, I was poor. I am rich today because I saw being poor as an opportunity, a very important resource God gave me to use to become rich." Good debt and bad debt. There are two types of debt, good debt and bad debt. Simply said, he said, good debt is debt that makes you richer and someone else amortizes, pays off, for you. Bad debt is debt that makes you poor, and that you have to amortize yourself. Money causes some people to do goofy things. For example, many people do something financially insane, like buy a big house, put in a swimming pool, use credit cards to pay the bills, and then use the equity on their home to pay the credit card bills. This is an example of taking a bad situation and making things worse, creating a budget deficit. Our government does the same thing. Many people in government think it takes money to solve problems, so the problems get bigger, requiring more money, which leads to a budget deficit. A very serious problem in the world today is excessive bad debt. Bad debt is debt from a liability. Bad debt is a drag on countries, businesses, and individuals. One way to become rich is to see bad debt as an opportunity, a resource to make you richer, not poorer. If bad debt is holding you back, then you may be your own worst enemy. When people borrow bad debt to solve problems, the problems definitely get worse and bigger. My suggestion is to look at the problem of bad debt as an opportunity to learn and grow smarter. After one of my businesses failed, I lost nearly $1 million. After selling off personal and company assets, I still owed about $400,000. To solve this bad debt problem, Kim and I came up with a plan to eliminate all of it. Once again, instead of cutting back, we instructed Betty the bookkeeper to keep us on track, and we used the problem to get richer, rather than poorer. In other words, we got richer while paying off all that debt. We continued to tithe, save, and invest, all while aggressively paying off all our bad debt. If you would like to know more about how Kim and I got out of bad debt, we created a CD called How We Got Out of Bad Debt, and a small accompanying workbook to guide those who are in bad debt. You can order it from our website, richdad.com, for a nominal price plus shipping. Looking back at our mountains of bad debt, I am glad Kim and I grew smarter at budgeting through our problem solving. While I never want to be that much in debt again, I am glad we learned from and solved the problem. When Kim and I were short of money, we used that problem as a resource to make more money. Rather than live below our means, or borrow more bad money to pay for bad debt, we used our problems as resources to become resourceful, and as opportunities to learn and become richer. Keep this in mind. Financial IQ number 3, budgeting your money, like financial IQ number 2, is measured in percentages, the percentage of income that reaches your asset column. If taking 30% of your income is too hard, then start with 3%. For example, if you earn $1,000, instead of allocating $300, or 30%, to your asset column, then direct 3%, or $30, towards your asset column. If this 3% makes life harder, that's good. A hard life is good if it makes you more resourceful. The higher percentage you direct to your asset column, the higher your financial IQ number 3. Today, Kim and I direct approximately 80% of our income directly into the asset column and do our best to survive on 20%. Also, we never say we cannot afford it, and we refuse to live below our means. By continuing to keep things challenging, we become more resourceful, creating a more abundant life and a budget surplus. Chapter 6. Financial IQ number 4, leveraging your money. On August 9, 2007, the stock market plunged nearly 400 points. The Federal Reserve and central banks around the world began injecting billions in cash into the economy to make sure the panic did not spread. The market was still nervous the next day. As I was getting ready for the day, a newscaster on a morning television program was interviewing 3 financial planners and getting their opinions. Their unanimous advice was, don't panic. Stay the course. When asked for further advice, all 3 said, save money, get out of debt, and invest for the long term in a well-diversified portfolio of mutual funds. As I finished shaving, I wondered if these financial experts had all gone to the same school for parrots. Finally, one advisor took a moment to say something different. She began by condemning the real estate market for causing the mess in the stock market, blaming greedy investors, unscrupulous real estate agents, and predatory mortgage lenders for causing the subprime mortgage mess, which led to the crash in the stock market. This advisor said, I told my clients that real estate was risky, and my advice has not changed. Real estate is a risky investment, and investors should invest for the long term in blue-chip stocks and mutual funds. As the financial planner on television was ending her attack on real estate, my wife Kim walked into the room and said, remember we have a closing today on the 300-unit apartment house. Nodding my head, I said, I'll be there. As I finished dressing, I thought, it's funny, the financial advisor saying that investing in real estate is risky. The real estate markets are crashing at the same time Kim and I are buying a $17 million apartment house in Tulsa, Oklahoma, and we are excited about it. Are we on the same planet? The new capitalism. On August the 9th and 10th, 2007, as investors lost billions of dollars, the U.S. Federal Reserve Bank was injecting billions of dollars into the banking system, doing its best to stop the panic in the real estate, stock, and bond markets. This injection of capital is an example of how the new capitalism operates, an economic system built on debt and manipulation by central bankers playing games with the world's money supply. It's almost like you and I using a credit card to pay our credit card bills. Later that week, I was asked to be a guest on 2 television and 3 radio programs to comment on the crash. The hosts wanted to know what I thought about it, as well as what I thought about the Federal Reserve injecting cash into a crashing market, and whether the Federal Reserve Bank should save the market by lowering interest rates. In all of my interviews I said, I don't like the central banks manipulating the markets. I don't feel the government should bail out the rich hedge funds and financial institutions, shielding them from their own greedy mistakes. I also said, I do feel for the little guy. In one day, millions of hardworking people who do not play games with money, watched their homes decline in value in the real estate market, their savings decline in value in the bond market, and their retirement portfolio decline in value in the stock market. When asked if I was continuing to invest, I said, yes. When asked if I thought it was risky to be investing in crashing markets, I replied, there is always risk. I then completed my thoughts by saying, the ups and downs of markets do not affect why I invest or what I invest in. 2 points of view. Although the question was not asked, I thought a better question might be, what is the difference between the financial planner who was negative on real estate and my point of view about investing in real estate? Or, why, while so many people were panicking, was I excited about buying more property? The answers to those questions are provided in this chapter through 2 financial concepts, control and leverage. As stated repeatedly in this book, the rules of money changed after 1971 and 1974. There are new rules and a new capitalism. In 1974, millions of workers began losing their paycheck for life, known as a defined benefit pension. They now had to save and invest for their retirement in defined contribution pension plans. The problem is most people have very little financial training or education in order to invest for their retirement properly. Another problem is the new rules of capitalism require workers to invest in assets they have no control and no leverage over. During market crashes, all most can do is watch helplessly as the financial hurricane whipsaws their wealth and financial security. The new capitalism puts millions of workers' money into investments that allow them very little control or leverage. Because I have control over my investments, in this example a 300-unit apartment house, I am not as affected by market crashes. Because I have control, I am confident about using a lot more leverage. Due to control and leverage, I can achieve greater wealth, in less time, with very little risk, and minimize the effect of the booms and busts of markets on my investments. The market has been crashing for a long time. As I wrote earlier, USA Today did a survey and found that the greatest fear in America was not terrorism, but the fear of running out of money during retirement. After August the 9th and 10th, 2007, I am sure that fear spread a little further. The people who are worried have good reason to worry. When you look at the two charts below, you can see the effect of the rule changes of 1971 and 1974 on the value of the stock market. As you can see, the market has actually been crashing for a long time. Just like housing, as the Dow is going up in price, its purchasing power is actually coming down. This loss of monetary purchasing power makes the financial future of most workers less secure. These charts say their future will cost them more money and become more expensive. Without leverage, most workers cannot put enough money aside for their future, because the more money they save the less valuable it becomes. There is a funny story about the German economy just before Hitler came to power that illustrates this concept. The story goes that a woman took a wheelbarrow filled with money to the bakery to buy a loaf of bread. After negotiating a price for the bread, she came out of the bakery to get her money, only to find that someone had stolen her wheelbarrow and left her money. This is happening to the American saver. How much will a retired person need in savings to afford retirement in such an inflationary economy? What happens if you are retired and need life-saving surgery, which government medical programs will not pay for? What do you do if your problem is not having enough money to retire on? This is why financial IQ number 4, leveraging your money, is so important. Leverage makes your money work harder for you by using other people's money, and if you have a high financial IQ number 3, you can pay less and less in taxes. What is leverage? In very simple terms, the definition of leverage is doing more with less. A person who puts money in the bank, for example, has no leverage. It's the person's money. $1 in savings has a leverage factor of 1:1. The saver puts up all the money. For my investment in the 300-unit apartment house, my banker put up 80% of the $17 million real estate investment. By using my banker's money, my leverage is 1:4. For every dollar I invest in the deal, the bank lends me $4. So why did the financial planner on TV say that real estate was such a risky investment? Once again, the answer is control. If an investor lacks the financial intelligence to control the investment, the use of leverage is very risky. Since most financial planners put people into investments where they have no control, they should not use leverage. Using leverage to invest in something you do not control would be like buying a car without a steering wheel and then stomping on the gas pedal. Most of the people being hurt by the real estate meltdown are people who were counting on the real estate market to keep going up and increasing their home's value. Many people borrowed money against their inflated home value. Now their home may be worth less than what they owe. They have no control over the investment and are at the mercy of the market. Many homeowners who still can make their mortgage payments feel bad because the value of their home has dropped. They watch the equity in their home disappear. When housing prices drop, many homeowners feel they have lost money. This is sometimes referred to as the wealth effect. Due to inflation, which is not really an increase in asset value but a decline in purchasing power of the dollar, many people feel wealthier as their home's value appears to increase. When they feel wealthier, they borrow more money, leverage, and spend more money on liabilities. This is a direct result of the new capitalism, an economic expansion based upon the decline of the dollar and an increase in debt. My worth is not based upon net worth. The wealth effect is rooted in the illusion of net worth. Net worth is the value of your possessions minus your debt. When a house goes up in value, most people feel their net worth has gone up. For those of you who have read my other books, you may already know that I feel net worth is worthless, for 3 reasons. 1. Net worth is often an estimate based upon opinions, not facts. The value of a home is only an estimate. You will not know the true price until the house is sold. This means many people overinflate their home's estimated value. Only until they sell their home will they know the facts, the real price and the real value. Unfortunately, many people may have already borrowed against the perceived value of their house and may owe more than they can sell the house for. 2. Net worth is often based upon possessions that have a declining value. When I fill out a credit application, I'm allowed to list most of my possessions in the asset column. I'm allowed to list my business suits, shirts, ties, and shoes as assets, just as I can list my cars. You and I know that a used shirt has very little value, and a used car has considerably less value than a new car. 3. Net worth going up is often caused by the dollar going down. Some of the appreciated value of a house is due to the decline in value of the dollar. In other words, the house is not going up in value. It just takes more dollars to buy the same house because the government and central banks keep injecting more funny money into the system to keep the economy afloat, and to keep the feel-good illusion of prosperity alive. A politician's greatest fear. The reason I used the words feel-good illusion of prosperity is because the greatest fear of politicians and bureaucrats is people feeling bad. Throughout history, kings, queens, and rulers have been overthrown and even executed when the people feel bad. You may recall the French people chopped off the head of their queen, Marie Antoinette, and the Russian people executed the last Tsar, his wife, and his kids. The old capitalism was based upon tough economic fundamentals. This new capitalism is based upon feel-good economics. As long as a person's net worth is going up, the illusion of prosperity, based upon debt, not production, continues. Who needs freedom when you've got things? As long as the world economy allows the US government and the US consumer to borrow and spend, the fairy-tale global economy will continue. If the dream turns into a nightmare and the feel-good bubble bursts, heads will roll again. They may not roll physically, but heads will roll politically, professionally, and financially. Value not based upon inflation. The value of my $17 million apartment house is not based upon inflation or the price of the building. While price is important, I am not counting on the price of the building going up due to some magical, unseen market condition. I am not counting on an increase in net worth to feel good, or worrying about a market crash and feeling bad. That is why the booms and busts of the markets do not concern me that much. The value of my apartment house is based upon the rent my tenants pay. In other words, the true value of the property is the value my tenants think the property is worth. If a renter thinks the apartment is a good value at $500 a month, that is the property's value. If I can increase the perceived value of my property to my tenants, I, not the market, have increased the value of the property. If I increase rents without an increase in perceived value, the tenant moves to the community down the street. The value of rental real estate, in this case my apartment houses, is dependent on jobs, salaries, demographics, local industry, and supply and demand of affordable housing. In a housing crash, the demand for rental units often goes up, which means demand and rents go up. If rents go up, the value of my rental real estate may go up, even if the value of residential real estate is coming down. There are 3 specific reasons why I'm not concerned about market crashes when it comes to the purchase of my 300-unit apartment house. One reason is because Tulsa, Oklahoma, is an oil-boom town. High-paying jobs are plentiful. The oil industry needs workers, and transient workers need rental housing. The second reason is because a local college near the apartment house is doubling its number of students, but not the number of on-campus housing units, which increases demand for rental apartments. As many of you know, there is another baby boom commonly referred to as the Echo Boomers, a generation just now entering college, which is 73 million strong. A majority of them will be renters. The third reason is because the fixed interest rate on the existing loan is very low. Low interest payments, lower expenses, and increasing income will increase property value, not market fluctuations. This means the 300-unit apartment house offers me both control and leverage. My job as an investor on this apartment house is to increase my leverage from 1 to 4 to possibly 110, i.e., doubling the value of the property through operations, not the market. I can do this as long as I have control. Leverage is not risky. Many financial advisors will tell you that higher returns mean higher risk. In other words, leverage is risky. That is absolutely false. Leverage is risky only when people invest in assets that they have no control over. If a person has control, leverage can be applied with very little risk. The reason most financial advisors say that higher returns mean higher risk is simply because they sell only investments that allow very little control. As mentioned above, my $17 million apartment house in Tulsa is a good investment to use leverage with because I have control over the operations, and the operations, i.e., the amount of income that is collected through rents, determine the value of the investment. A house is not a good investment, and leverage is risky with a house because you do not control the value of the house. The value of a house is based on the market and the purchasing power of the currency it was purchased with. These things are out of your control. What is control? The major flaw in paper assets such as savings, stocks, bonds, mutual funds, and index funds is the lack of control. And because you have no control, it is difficult and risky to apply leverage. Because these paper assets offer very little control, it is difficult to get a bank to lend you any money to invest in these assets. So, what is control? The diagram of the financial statement illustrates 4 of the main controls a professional investor and a banker want. As an entrepreneur, I have control over the 4 columns in the financial statement of my business. As a real estate investor, I also have control over the 4 columns of the financial statement of my investment. Financial intelligence is the key to control. Financial intelligence is the key to control. Financial intelligence increases control, and financial IQ measures the financial returns of financial intelligence. Take the 300-unit Tulsa apartment house as an example. 1. The income column. The first step after acquiring the property is to increase the rent. The property is already profitable and cash flows with existing rents. In other words, I am already making money from day one. Even so, the objective or business plan is to raise the rent per unit an additional $100 a month over the next 3 years by the following means. 1. Raising the existing rents that are under market. 2. Installing washers and dryers in all the units and charging extra for rent. 3. Completing improvements to the property like landscaping and new paint. All of these can be completed by using the bank's money, not mine. When we provided the bank our business plan, these improvements were part of it, and were factored into the total loan amount. Multiplying 300 units by $100 over 3 years, this increases the entire project's monthly income by $30,000 a month, or an additional $360,000 a year. This increase in income is an example of control and leverage. If the plan works, 3 years from now my financial IQ number 4, leverage, will be infinite because the increase in income will be achieved by no additional capital from investors, just good knowledge of how to manage the asset, control, to higher and higher profitability. The increase in financial IQ is infinite because the increase in income will be achieved using investor control and the bank's money. 2. The expense column. The next controllable objective is to lower expenses. This is done in different ways. One specific example is by reducing labor costs through reduced administrative costs. Since we own other properties, many costs can be brought back to the main company. These are sometimes called back-office expenses. They are the cost of accountants, bookkeepers, attorneys, and administrative staff. Other expenses that can come down are insurance, property taxes, water consumption, maintenance, and landscaping through better cost management and economy of scale. Also, expenses can be reduced and income can go up by keeping turnover low, the time it takes to re-rent an apartment. For example, the moment a tenant informs the management company that he or she is leaving, an ad is run advertising the apartment's availability. Once vacated, the cleaning crew comes in that day, and the apartment is ready to show to a potential new tenant that night. And in many cases, an apartment is rented before the existing tenant even moves out. Obviously, many incompetent investors fail to reduce expenses and actually increase them, making the property a bad investment for them. Often, they fail to manage the quality of tenants and the attractiveness of the property because they are trying to save money. In most cases, the property goes down in value. It's these poorly run properties that we like to buy because we can turn them into good investments through good property management. In other words, we make good money from bad investors. Property management is a key control. As you know, property management is one of the keys to profitability of real estate. Property management is a key control. Like most investors, I hate property management. That is why I have Ken McElroy, author of the ABCs of Real Estate Investing, as a partner. His company is absolutely the best. If you would like more information on property management or how to increase the value of real estate through property management, the Rich Dad Company offers several books and audio products created by my friend and investment partner Ken, whose company is a leading property management company in the southwestern United States. One of the reasons why I stay clear of most stocks and mutual funds is because I have no control over expenses, especially management salaries, bonuses, and fees. It makes me sick to read about a greedy CEO's increase in pay, even as shareholder value drops. For example, Robert Nardelli, CEO of Home Depot, was being paid $38 million a year in salary, plus a guaranteed $3 million bonus each year. Unfortunately, things didn't go well and Nardelli finally resigned, but only after the board of directors agreed to pay him $210 million to do it. To me, this is excessively expensive, and a rip-off. It's why I don't like paper assets. Most paper assets are run by MBAs, employees who think more about their personal finances than their investors' financial security. By the way, Home Depot's executive compensation, while high, is not necessarily an exception. It's the norm. 3. The liability column. My 300-unit apartment house had an existing mortgage interest rate of just 4.95%. The low interest rate increases the asset value of the entire property. By adding a second mortgage at 6.5%, we created a blended rate of about 5.5%, taking into account the different amounts of the two loans. This low interest rate is an important control and leverage. A percentage point on millions of dollars has a great impact on net income. For example, a 1% savings on a $10 million mortgage is $100,000 in extra income annually. As the diagram below illustrates, reducing debt and interest rate expense on debt is also an example of leverage. 4. The asset column. By increasing rents, reducing expenses, and reducing debt, or interest on debt, the asset value of the property increases. As you can see by the financial statement diagram below, having controls and getting numbers to move in the desired direction are a form of leverage, and a function of financial intelligence. Bobbing for apples. Today, with the ups and downs of the market, many investors look like old-time carnival goers who bobbed for apples floating in a tub of water. It looks like fun, but it's not something I want to do every day just to make a buck. Rather than watching the price of my stock or mutual funds bob up and down in the market, I want control over my financial statement. By having the financial intelligence to control income, expenses, debt, and ultimately the value of my investment, I have control over my financial destiny. The investor has no control and no leverage power in any of the four columns of the financial statement with savings, stocks, bonds, mutual funds, or index funds. A pause before going on. Before going on into higher forms of leverage and control, I believe it is important to recap and review the points covered so far before getting more complex. These are the 7 points. Point number 1, there are many types of leverage. The financial leverage most people are familiar with is the leverage of debt, aka OPM, other people's money. There are other types of financial leverage, such as the leverage of financial intelligence applied to financial controls. In fact, all 5 financial intelligences, which are increasing income, protection from predators, budgeting, leverage, and information, are forms of leverage. Leverage is anything that makes your job a little easier. It's easier to move a heavy object with a forklift, and it's easier to make a sophisticated investment decision with a higher financial IQ. Point number 2, most investors invest in paper assets they have very little control over. Examples of paper assets are savings, stocks, bonds, and mutual and index funds. Because these assets allow little to no control, these investors have very little leverage and low returns on investment, and reflect a low financial IQ. An example of low financial IQ is a 5% return on savings, paying taxes on that return, and then having inflation almost wipe out its value. Point number 3, an increase in returns does not mean an increase in risk. When financial advisors say that an increase in returns means an increase in risk, they are right when speaking about paper assets. They are wrong when speaking for all assets. Assets such as a business or real estate require more financial intelligence, allow for more financial control, and permit a higher degree of leverage with very low risk. The key to low risk is higher financial intelligence. This is why I recommend that people start small and stay small, as they allow their financial intelligence to increase. With an increase in financial intelligence, their returns on their investments increase. If financial intelligence is low, then leverage may deliver a blow to financial IQ, the measured returns on the investments. Point number 4, most financial advisors are not investors. Financial advisors are simply salespeople. Most financial advisors, even many real estate brokers, invest only in paper assets, if they invest at all. Most have very little leverage professionally and financially. In many cases, their professional and financial leverage ratios are 1-to-1. A 1-to-1 professional ratio means they get paid for their work, and only their work, a day's pay for a day's work. As a business owner, I have thousands of people working to assist me. As an investor, like in the example of the Tulsa apartment house, I have 300 tenants helping me pay for my investment, the bank lending me $4 for every one of my dollars, and the tax department giving me tax breaks on my income. These are examples of different types of leverage. Point number 5, financial education increases financial intelligence. Most people invest in paper assets such as savings, stocks, bonds, and mutual and index funds because they do not need or want control. All they want is to turn their money over to an investment advisor who hopefully does a good job. Out of sight, out of mind. If people want more control, the first thing they need to control is their financial education, which increases their financial intelligence and hopefully increases their financial controls and leverage ratios. Point number 6, leverage can work in 2 ways. Leverage can make you rich and leverage can make you poor. This is why leverage requires financial intelligence and financial controls. With stocks, a trader can use the leverage of options. If a trader thinks the market is going up, the trader may use a call option, which is the right to purchase a stock at a certain price within a certain time. For example, if the stock is $10 today and the trader senses the price will go higher, the trader may buy a call option for $1. If the trader is correct, and the stock goes to $20, the trader has made $10 with $1. If the trader thinks the market is going down, the trader may use a put option, or short the stock. In other words, a trader has the potential to make money if the stock price is going up or going down. The problem, however, is that the trader has no control over the asset, just control over the terms of their trade. As expected, most financial advisors who sell mutual funds and recommend diversification say that trading a stock is risky, and it is for those who lack training and experience. Learning to trade a market, even in real estate, is an important part of an investor's financial education. Real estate investors also use options. In real estate, a call option is known as a down payment. If you are a flipper, a down market in real estate can be disastrous. Since most of my investment in real estate is based upon rental prices and operating costs of a property, up and down markets in real estate do not affect me as much. While I do occasionally flip a property, especially if someone is willing to pay me a ridiculous price for it, as a practice I would rather buy a property and collect rent and other income for a long time. Then I look for another property to buy and hold. For those who are interested in learning about investing in up and down markets, we have our board game Cashflow 202, a game that teaches you to trade with play money. Cashflow 202 is an addition to Cashflow 101. It is strongly recommended you start with Cashflow 101 before moving on to Cashflow 202. There are cashflow clubs all over the world for people who want to learn the games before purchasing them. Financial education is essential for anyone wanting to use more leverage. Point number 7, when most financial advisors recommend diversification, they are not really diversifying. There are 2 reasons why the diversification they recommend is not diversification. The first reason is that financial advisors invest in only one category of asset, paper assets. As the market crash of August 9 and 10, 2007, revealed, diversification did not protect paper asset values. The second reason is that a mutual fund is already a diversified investment. It is a hodgepodge of good and bad stocks. When a person buys several mutual funds, it is like taking several multivitamins. When a person takes multiple multivitamins, the only thing that goes up in value is the person's urine. Professional investors don't diversify. As Warren Buffett says, diversification is a protection against ignorance. Diversification is not required if a person knows what they are doing. My rich dad would say, whose ignorance are you protecting yourself against, your ignorance, your advisor's ignorance, or your combined ignorance? Instead of diversify, professional investors do 2 things. One is to focus only on great investments. This saves money and increases returns. The second is to hedge. Hedging is another term for insurance. For example, my 300-unit apartment house is required by the bank to have all sorts of insurance. If the property burns down, insurance pays my mortgage and rebuilds the building. Best of all, the cost of the insurance is paid out of the rental income itself. 2 of the main reasons I do not like mutual funds is that banks do not lend money on them and insurance companies will not sell me insurance against catastrophic loss if the market crashes, and all markets crash. Onto more leverage, higher returns, and lower risk. Focus, not diversification, is the key to more sophisticated leverage, higher returns, and lower risk. Focus requires more financial intelligence. Financial intelligence begins with knowing what you are investing for. In the world of money, there are 2 things investors invest for: capital gains and cash flow. 1. Capital gains. Another reason so many people think investing is risky is because they invest for capital gains. In most cases, investing for capital gains is gambling, or speculation. When a person says, I'm buying this stock, mutual fund, or piece of real estate, he or she is investing for capital gains, an increase in the price of the asset. For example, if I had purchased the $17 million apartment house hoping I could sell it for $25 million, then I would be investing for capital gains. As many of you know, investing for capital gains means a tax increase in some countries. 2. Cash flow. Investing for cash flow is a lot less risky. Investing for cash flow is investing for income. If I put savings in the bank and receive 5% in interest, I am investing for cash flow. While interest is low risk, the problem with savings is the return is low, taxes can be high, and the dollar keeps losing value. When I purchased the 300-unit apartment house, I was investing for cash flow. The difference is I was investing for cash flow using my banker's money for a higher return on investment and paying less in taxes. That is a better use of leverage. What are you investing for? Most financial advisors recommend that a person invest in growth funds when he or she is young. Investing for growth is investing for capital gains. They advise older investors to then shift their growth funds into income funds or annuities. In other words, invest for cash flow when you are older. They believe cash flow is less risky and more certain. 3 types of investors. When it comes to capital gains or cash flow, there are 3 general types of investors. They are: 1. Those who invest only for capital gains. In the world of stocks, these people are called traders, and in the real estate market they are called flippers. Their investment objectives are generally to buy low and sell high. When you look at the cash flow quadrant, traders and flippers are actually in the S quadrant, not the I quadrant. They are considered professional traders, not investors. On top of that, in America, traders and flippers are taxed at the higher S quadrant tax rates and do not enjoy the benefits of the tax breaks the I quadrant receives. 2. Those who invest only for cash flow. Many investors like savings or bonds because of the steady income. Some investors love municipal bonds because they pay a tax-free return. For example, if an investor buys a tax-free municipal bond paying 7% interest, the effective return on investment, ROI, is the same as receiving a 9% taxable return. In real estate, many investors love triple net leases, NNN. With NNNs, investors receive income without the expenses of taxes, repairs, and insurance. The tenant covers those costs. In many ways, a triple net lease is like a municipal bond, because a lot of the income can be tax-free or tax-deferred. While I love triple net properties, as expected, the trouble is finding a good property with a good tenant willing to pay a high return. Today, as I write, most NNN properties are only paying about a 5% to 6% return. Not that exciting. The good news is that if I dig deeper, which I will go into later, I might be able to find a property with a much higher return, all the while using more leverage and my bank's money to lower my risk, which is why I prefer triple net real estate over tax-free municipal bonds. This leads us to the third type of investor. 3. The investor who invests for capital gains as well as cash flow. Years ago, old-time stock investors invested for both capital gains and cash flow. Old-timers still talk about the price of a stock going up as well as paying the investor a dividend. But that was in the old economy, the old capitalism. In the new capitalism, most paper investors are looking for the quick buck, to make a killing. Today, the big investment houses are hiring the smartest whiz kids out of college and using the power of supercomputers and computer models to look for the slightest market patterns they can exploit. For example, if the computer picks up a 1% differential, let's say in tech stocks, the investment house will bet millions of dollars, hoping to gain 1% on millions of dollars in a few hours. This is very high leverage, and very risky. These computer models also cause a lot of the volatility in the markets and often cause crashes. When the stock market announces that program trading has been halted, it is talking about these computer programs being halted. The markets crash if the computers say sell. If the computers say buy, the markets boom, and then they crash. In other words, prices can go up or down for no fundamental or business reason at all. A stock price may have no relationship to the value of the company because the computers created an artificial supply or demand. If you recall the dot-com era, companies that were not companies, but rather just good ideas, were valued at billions of dollars, and companies that were really valuable had their share prices trashed when the dot-com boom busted. As an old-time investor in this new era of capitalism, I must be smart enough to invest for capital gains, cash flow, leverage of debt, and tax advantages, as well as be above the turmoil the whiz kids and supercomputers cause in the marketplace. For instance, I recently purchased a stock, even though I do not have control, because the company, an old boring industrial age company, historically pays a steady 11% dividend. When the share price dropped in the recent market crash, I bought the stock because the price of the cash flow became cheaper. So I do occasionally buy paper assets, but I tend to buy for cash flow. Being a little guy and not having control over the company, I do not use leverage. I only invest with cash I can afford to lose if I'm wrong. If this particular stock goes up in price, I may sell because I like investing for both cash flow and capital gains. My ROI, return on investment, goes up if and when I can receive both cash flow and capital gains. There are 3 components to being a good real estate investor. They are: 1. Good partners. As Donald Trump says, you cannot do a good deal with bad partners. This does not mean bad partners are bad people. They may just be bad or wrong partners for you. For this 300-unit apartment house project to work, I must be sure I have good partners. My partners are my wife, Kim, Ken, and Ross. We have done many deals together and have made a lot of money. We have also run into many problems, and in solving the the problems have become smarter and better partners. 2. Good financing. Real estate is primarily a function of financing. Many people say, location, location, location. I say, financing, financing, financing. If you can secure good financing, the deal works. If you have bad financing, the deal will not. To illustrate my point, let's say the seller says, I want $35 million for my $17 million apartment complex. If the seller lets me finance the $35 million purchase price at $1 a month for 30 years with a balloon payment of $35 million at the end of the term, I would take the deal and give the seller the asking price. At $1 a month for 30 years, I can afford to pay $35 million for a $17 million property. As they say in the world of finance, I'll give you your price if you will give me my terms. I know some of you think $35 million is just an extremely ridiculous example. It actually is not. In the world of finance, paying ridiculous prices is pretty common. It is often just a matter of who the buyer and seller are and their ability to use the power of finance to achieve their goals. For example, a few years ago, a piece of property came up for sale near my office. When I asked the broker what the price was, he said $2 million. I laughed, said he was joking, and left. At best, I thought the property was worth $750,000. Today, a major hotel chain is putting a flagship property on that piece of dirt. I do not know what that piece of dirt is worth today, but it is definitely more than $2 million. As my friend Ken McElroy says, the person with the better plan wins. And as Donald Trump says, think big. Every time I drive past that property, I say to myself, think bigger, bigger. 3. Good management. One of the reasons for my confidence in the $17 million, 300-unit property is that I have good partners. Ken owns a property management company, and his partner Ross owns a real estate development company. In the following paragraphs, I will further explain how property management and development are essential to increasing rents, lowering expenses, and increasing asset value. If I had bad partners, bad financing, and bad management, the 300-unit apartment deal would be a financial disaster. If I were the only one investing, I would not invest. It is too big and complex a project. Having control over these three components, good partners, good financing, and good management, I am more willing to use debt as leverage. Without control, I would probably not use debt financing. If there is higher risk, such as speculating in a stock or a commodity, I like to use only money I can afford to lose. Higher returns with less risk. I'm going to further explain my confidence in the investment, thanks to my partners and having control over the 300-unit apartment project, why I am willing to use a lot of leverage, why I believe the risk is low, how I make more money, and how I pay less in taxes. There are 3 more advanced investment strategies that require a higher level of financial intelligence. The 3 advanced leverage strategies are OPM, ROI, and IRR. 1. OPM, other people's money. There are many ways to use OPM. With the 300-unit apartment building, I am using 80% leverage. First of all, the beauty of using the bank's money is that it is tax-free money. The other benefits of the bank's money are: Mi Bank. 1. Appreciation 100% 0%. 2. Income 100% 0%. 3. Tax benefits 100% 0%. 4. Amortization 100% 0%. As you can see from these numbers, the bank puts up 80% of the money but I receive 100% of the benefits. What a great partner. 2. ROI, return on investment. A confusing concept for many investors is the return on their money, or ROI. For example, when you read financial publications, many mutual funds claim they have gone up by 10%. But my question is, did any of that 10% return to the investor? And how did they measure that 10%? Some funds measure the 10% by the price of the shares in the fund going up. For example, if a year ago the price per share in the fund was $10 and today it's $11, they can claim a 10% return. In this case the return was measured in capital gains. As an investor who invests for both capital gains and cash flow, the only return I count is the cash flow. For example, if I invest $10 and each year after taxes I put $1 in my pocket from cash flow, my return is 10%. I do not count the return on asset appreciation because it is an estimate and does not become a reality unless I sell the asset. The difference is that one measure of the ROI is in the price of the stock, and the other measure of ROI is money in my pocket. I actually want both, 10% in asset appreciation and 10% cash in my pocket. But cash flow is the only return that can be tangibly measured while I hold the asset. Matching 401k contributions with one's own money. Another confusing point is that financial planners claim companies match your retirement fund contributions. If the match is $4 up to a certain percentage, the advisor may claim that this is 100% ROI. That is not how I see it. My way of looking at matching contributions is that the company is simply putting my money in with more of my money. In other words, the contribution the company withholds and then contributes is still my money. It is money the company should have paid me anyway. It is part of my total compensation, an expense to the company. When I talk about leverage returns, I am talking about someone else's money, not my money. More leverage, higher returns. The reason leverage is so important is because the higher the leverage, the higher the return. For example, if I buy a $100,000 rental unit with my money, and I receive $10,000 a year net income, my cash-on-cash return is 10%. If I borrow $50,000 and am still able to receive a $10,000 return, my cash-on-cash return is 20%. If I finance the entire $100,000 and still receive a $10,000 return, my return is infinite. Infinite returns mean money for nothing. $10,000 flows into my pocket, and nothing comes out. The renters cover my expense, and I receive the income. Money for nothing. In my next example, again using the 300-unit apartment house, I will explain how I receive an infinite return by using leverage. The way this will be done is by raising rents and adding washers and dryers to each of the 300 units. This is how the numbers work in oversimplified terms. The net $100 a month increase in rents is due to increased rents to match the competition, upgrades to the exterior, and fitting each unit with washers and dryers. This $100 a month increase in income is a 100% finance transaction. We get extra money from the bank to do the renovations. We have the control. The increase in debt is more than covered by our increase in income. This extra $100 is technically an infinite return because all the expense is fronted by the bank, and all the returns come to me. The increase of $100 per month is multiplied by 300 units. This is an increase in gross income of $30,000 a month, and $360,000 a year on top of the cash flow we are already getting. This $360,000 is an infinite return, measured by cash flow in hand, not some fictitious capital gain on paper. In summary, the bank puts up 100% of the money for these improvements and we receive the increase in income. The tenants pay for expenses and the mortgage. 3. IRR, internal rate of return. One of the more complex, sophisticated, and often confusing measures of ROI is the internal rate of return. If investors really know what they are doing, they can increase their ROI by understanding IRR. The following diagram explains as simply as possible this more advanced way of measuring true investor returns. In overly simplified terms, internal rate of return, IRR, measures the other returns and other leverage that a well-controlled investment can provide. 1. Income column, passive income. Most people understand that gross rents are part of the income column. Yet IRR also measures other forms of income. Passive income is subject to lower tax rates than earned income. In the US, passive income is not subject to Social Security or self-employment taxes. In other words, these taxes do not show up as expenses in the expense column, which is technically a gain in income. 2. Expense column, depreciation. In the US, the tax department gives some investors an additional income that actually looks like an expense. This income is known as depreciation. Another term for depreciation is phantom income. The reason it is phantom income is because it's income that shows up somewhere else. For example, let's say my tax bill is $1,000. The IRS may allow me to depreciate my investment by $200, allowing me to pay only $800 in taxes. This additional $200 is phantom income, or money I did not have to pay. It is $200 that remains in my pocket instead of going to the government. Depreciation is allowed for such things as refrigerators, ceiling fans, carpet, furniture, and other items that decline in value with age. A tax accountant can explain this to you if you own a business or real estate. There is no such thing as depreciation for paper asset investors. 3. Liability column, amortization. Another form of income to the investor is known as amortization, which is a fancy word for paying off debt on a scheduled basis. When you have good debt that someone else such as a renter pays for you, amortization becomes income to you. In other words, as a tenant pays down my debt, that payment is technically income to me, income that is paid to reduce my debt as my cash stays in my pocket, ready for the next great investment opportunity to come my way. Additionally, while my tenant is paying down my debt, I still receive all the tax benefits associated with my investment. 4. Asset column, appreciation. Appreciation is the increase in asset value. This is also income to you. This is not appreciation based upon some appraiser's idea of an increase in sales price based on comparative sales in the area. The way I measure appreciation is by the actual increase in income to my income column. For example, the increase of $360,000 in income from my 300-unit apartment house is measurable. This is not an exact method for defining IRR, but it gives you an idea of how an investor can increase his or her return on investment far higher than most investors can receive from paper assets. At least you have an idea of what an IRR is. I would guess 95% of investors have never heard of internal rate of return. So you are now smarter and sharper than 95% of the investors out there. The exit strategy. The beauty of the exit strategy on the 300-unit apartment house is once again the use of leverage to become even richer. Instead of selling the property and facing substantial capital gains taxes on the profit, we pull out the money by refinancing. We are able to do this because we have increased the value of the property through our improvements and management. The bank recognizes this increase in value and we are able to borrow against it. By leveraging the property's value, we pull money out of the property tax-free, and the improved operations more than cover the higher mortgage payment through higher income. By borrowing rather than selling, we get our down payment back, tax-free, and we get to keep the asset. At this point, the property's income is an infinite return because we have no money invested in the deal, yet we receive the income. This is the ultimate leverage. Let's say after 5 years we are able to refinance the property and pull out $4 million tax-free. The numbers are in the diagram on page 122. The $4 million refinance dollars go to the investors and pay back all initial equity and then some. Even better, we still maintain control over the 300 units, and the increased mortgage payment of $280,000 is paid for by the $360,000 increase in income. The $360,000 increase in rental income minus $280,000 in increased interest expense leaves a net $80,000 in passive income. This $80,000 is an infinite return because the investors have received back their initial investment, yet still receive cash flow. It is free money. The investors get $4 million back and move on to purchase another apartment house. This is an example of using control and leverage. This is an example of getting rich according to the rules of the new capitalism, capitalism based on the use of debt to become richer. Rather than work hard to get out of debt, as those who follow the rules of old capitalism do, we work hard to find ways to get into more good debt and use more leverage. Starting with nothing. To some of you, a $17 million, 300-unit apartment building sounds like a big investment. To some of you, it's a small investment. 10 years ago, buying a 300-unit apartment seemed big to Kim and me. 10 years from now, I am certain it will seem like a small investment. Kim, Ken, and I are already planning much bigger projects to take on. Donald Trump and I are looking at a massive project not far from my home, a project we will break ground on in 10 years. I mention the size and dollar amounts of projects to make 3 points. 1. Being born poor and financially uneducated does not mean you cannot become rich. Very few people are born rich enough to buy a $17 million apartment complex. And no one is born smart enough to acquire, finance, and manage a 300-unit apartment complex by themselves. In other words, not having any money or financial education isn't an excuse not to get started. Yet billions of people let the problem of not having money or enough education stop them from becoming rich. They fail to take the first step. And if they do take the first step and then fail, make a mistake, lose money, or run into problems, many quit. That is why for billions of people, a $17 million project will always seem like a big project, a project bigger than their dreams. 2. Start small and take baby steps. In 1989, Kim's first investment was a $45,000 two-bedroom, one-bath home in Portland, Oregon. She put $5,000 down and made $25 a month. She was extremely nervous when she took her first step. Today, a $17 million apartment house is boring to her. She is ready for bigger projects. In 1997, Ken McElroy started with a two-bedroom, two-bath condo in Scottsdale, Arizona. It cost $115,000, and he put down $23,000. He made $50 per month in cash flow. Today, he controls a real estate portfolio worth hundreds of millions of dollars. I bought my first investment property in 1973. I had no extra money to invest. I was still in the Marine Corps and had just purchased my first home. Rather than let low pay and no money stop me, I signed up for a real estate investment course for $385. Within a few months I purchased my first investment property, a one-bedroom condo on the island of Maui, for $18,000. The property was in foreclosure, and the bank was desperate to get rid of the unit. The bank let me put the $2,000 down payment on my credit card. The property made me about $35 a month after paying my mortgage and credit card bill, which is an infinite return, since I borrowed 100% of the money. Once I proved to the bank that I could manage the property, it let me buy 2 more units. My investing career was launched. About a year later, I sold the 3 properties for approximately $48,000 each and put nearly $90,000 in my pocket. Not a bad return on a $385 seminar and credit card down payments. Even though I did it, I do not recommend that people use credit cards to make down payments. I do, however, recommend that a person read books and attend seminars before investing. One of the reasons the Rich Dad Company has intensive investment seminars is because I strongly believe in the power of our minds. Our minds are our most important form of leverage. At our seminars, the instructors are fabulous. I must admit that they are better teachers than I am. They are much more focused and thorough with their content and delivery. They are well trained, dedicated to your success, and, most importantly, they practice what they preach. Most students report that our courses open up their minds to a world of new opportunities, different ways of becoming financially free, and change their lives forever. You can find out more information on our website, richdad.com. 3. Dream big. Most of us know that a child must be allowed to dream. The same is true for adults. As a couple, Kim and I have big dreams. Our dreams keep our marriage rich, young, and fun. Bigger investment projects keep us learning together, operating as a team, and growing together rather than growing apart. Instead of living below our means, we dream big, learn, and invest carefully in order to go beyond our means. It's not just about money, it's about life. Personally, Kim and I think it is a tragedy to live below your dreams. In conclusion, on August the 9th and 10th, 2007, as the markets of the world crashed, many people had no idea what the crash meant. Most people have no idea how it will affect their lives. Most people have no idea how the rule changes back in 1971 and 1974 have affected their lives. Today, even in the richest country in the world, the US, millions of educated, hardworking people are earning less even if they are paid more, saving money that is losing value, clinging to their homes as their value declines, and using credit cards to pay their bills. To make matters worse, because of a market crash, millions of educated, hardworking people think that investing is risky and to attain higher returns means you have to take on greater risks. There are only a few people who know that the key to leverage is control, and the key to control is financial intelligence. The good news is that the higher your financial intelligence, the more money you make without needing money. In this new capitalism, it is truly possible to make money for nothing. In the information age, knowledge is the ultimate leverage. The more money you make without money, the higher your ROI and IRR, and the higher your financial IQ. Since financial IQ is the numerical measure of financial intelligence, this means an infinite return means an infinite financial IQ. Tell that to your banker and financial planner the next time they tell you that 5% interest on savings, or 10% return on mutual funds, is a great return. Chapter 7. Financial IQ number 5, Improving Your Financial Information. In January of 1972, I was transferred from Camp Pendleton, California, to an aircraft carrier off the coast of Vietnam. It was my second trip to Vietnam. My first visit was in 1966. The Merchant Marine Academy sent students to sea for a year of study. My project was studying military cargo operations in a war zone, more specifically, how to safely load and unload bombs without killing ourselves. My second trip as a war pilot was a very different experience than studying the war as a student. My primary job on board the carrier was as a helicopter gunship pilot. My primary mission was to fly as an escort for the larger troop helicopters. Our squadron was made up of mostly troop transport helicopters, the twin-rotor CH-46 and CH-53s, aka Jolly Green Giants. If the zone was hot with enemy fire, the job of the gunship was to protect the troop transport helicopters in the zone. Personally, I was happy to be a gunship pilot. It was a lot better than being a troop transport pilot. Transport pilots had to be extremely brave. They flew large helicopters into a hot zone, just sitting there as troops got on or off. Top secret job. My secondary job was as an assistant to the squadron's top secret information officer. It was an extremely interesting job. For hours on end, we would sit, listen, observe, gather, and process top-secret information. At regular intervals during the day and the night, we gave briefings to the commanding officer and his team. Our job was to take raw data from the war and turn it into relevant information. Life or death information. As an information officer, I gained a tremendous respect for information. Prior to Vietnam, I never thought much about the subject. In school, I thought the study of information was a joke. To me, information was just data, mindless facts and figures, dates and times to be memorized in order to pass tests. In Vietnam, information was more important. It could mean life or death for my fellow pilots. Today, I believe that I am a better entrepreneur and investor because of my position as information officer. Today, I know that information can mean life or death in war and the difference between being rich or poor in business. Information more important than life. In the process of preparing to go to Vietnam, we were trained to process infinite bits of information and be able to make split-second decisions under intense pressure. If we did a good job processing the information, we lived. If we didn't, we risked death. Once I realized that my life and the lives of others were dependent upon the quality of information I received, it became more important than even my own life. In a previous book, I wrote about the first day I came under fire in Vietnam. I described the fear as well as the realization that the guy firing at me wanted to go home as much as I did. In the book, I related my crew chief's words of wisdom reminding me that in war there was no second place, no silver medal. It was gold or nothing. Watching real bullets screaming up at us, I realized school days were officially over. As we flew towards our death, years of training and information were being processed into one decision, one action. The good news is that my crew and I returned home that night. Sadly, the Vietnamese on the ground didn't. There was no second place. The most important asset. A friend of mine who is a Bible scholar often says, "Without knowledge, my people will perish." Today many people are perishing because they are without knowledge about money. We live in the information age. Even in very remote areas of the world, I have seen young people text messaging while at the same time riding the family's donkey cart. Never before has the entire world been so connected so quickly. Information is the single greatest asset of this era. In previous ages, you owned factories, cattle ranches, gold mines, oil wells, or skyscrapers to be rich. In the information age, information alone can make you very rich. You don't need tangible resources like land, gold, or oil. The young entrepreneurs who created MySpace and YouTube have proved that. With just a few dollars, some information, and the leverage of technology, these 20-year-olds have become billionaires. Likewise, poor or mistaken information is a liability. Poor information creates poor people. One of the reasons so many people are struggling financially is simply because they have obsolete, biased, misleading, or erroneous information powering their most powerful asset, their brain. Many people who are struggling are doing so because they are using industrial or agrarian age information in the information age. Examples of industrial age information are ideas such as, I need a good education to get a high-paying job. An example of agrarian age information is, land is the basis of all wealth. The 4 ages of humanity. There have been 4 economic ages of humanity. 1. The hunter-gatherer age. During this period nature provided the wealth. Tribes followed herds or searched for food. If you knew how to hunt and gather you survived. If you did not, you died. The tribe was social security. Socio-economically, everyone was even. The chief didn't have a higher standard of living than the rest of the tribe. He may have eaten first and had more wives, but basically, fire was fire and a cave was a cave. In terms of money, there was only one class of people. Everyone was poor. 2. The agrarian age. Once humans learned how to plant seeds and domesticate animals, land became the wealth. Kings and queens owned the land, and everyone else worked on the land and paid a tax to the royals. That is why real estate, strictly translated, means royal estate. With the advent of domesticated animals, the royals rode horses and the peasants walked. That is why the word peasant is a derivative of many words broadly meaning on the land and on foot. Peasants own nothing. Socio-economically, there were 2 groups, the rich and the peasants. 3. The Industrial Age. In 1492, Christopher Columbus and other explorers went in search of trade routes, land, and resources. To me, that's when the Industrial Age really began. In the Industrial Age, resources such as oil, copper, tin, and rubber were wealth. During this era the value of real estate changed. In the Agrarian Age, land had to be fertile and able to grow crops or raise animals. In the Industrial Age, non-agricultural land became more valuable. For example, Henry Ford built his auto plant in Detroit because he could buy large tracts of rocky, unfertile, non-agricultural land for a great price. Today, industrial use land has a higher value than agricultural land. Socio-economically, a new class emerged, the middle class. There were now 3 groups of people, the rich, the middle class, and the poor. 4. The Information Age. This age officially started with the invention of digital computers. In the Information Age, information leveraged by technology is wealth, and very inexpensive and abundant resources, such as silicon, produce the wealth. In other words, the price of getting rich has gone down. For the first time in history, wealth is available, affordable, and abundant for everyone, regardless of where he or she lives. Socioeconomically, there are now 4 groups of people, the poor, middle class, rich, and super-rich. Bill Gates is the most obvious example of the information age super-rich. The super-rich. Today the super-rich can derive their wealth from any era. It's possible to be a super-rich hunter-gatherer as the Maori from New Zealand are from fishing rights. You can also be a super-rich rancher or farmer from the agrarian age, and be a super-rich automaker from the industrial age. As already mentioned, there are super-rich 20-year-old billionaires of the information age, young people who became super-rich with the inexpensive and abundant resources of technology, information, and their ideas. The common bond among all these is that information enabled the coordination of resources at a much quicker and higher level than ever before. It is this coordination that creates the super-rich. The gap. At the same time, there are people who are perishing because of obsolete or inadequate information. There are indigenous tribes who are being wiped out as their forests are taken away. There are farmers going broke, and automakers laying off thousands of workers. Once prosperous record store chains are now being wiped out by downloaded music. In America, the richest country in the world, we have millions of people who are deeply in debt, clinging to the last strands of job security, and wondering how they will afford an education for their kids and a retirement for themselves. Millions struggle in this rich country because they continue to operate with hunter-gatherer, agrarian, or industrial-age ideas. The widening gap between the superrich and everyone else is made by information. The good news is that information is abundant and free. Today, it's relatively easy for a person, even the very poor or the young, to go from nothing to superrich without much money. To be rich today, you do not have to be a conquistador, sailing to foreign lands and robbing the indigenous people of their resources. You do not need to raise millions of dollars in the stock market to build a car factory or employ thousands of workers. Today, information and a very inexpensive computer can transport you from poor to superrich while you're sitting at home. All it takes is the right information. Information overload. So, the good news is that information is abundant and free. The bad news is that information is abundant and free. The irony of the information age is that there is too much of it. Today, people complain about information overload. At any given moment, a person can be watching television, surfing the internet, and talking on the phone, while driving past digital billboards. In previous ages, no one complained about too much land or oil. Yet in the information age, people complain about having too much information and being overloaded with the very asset that could make them superrich. Military intelligence. In Vietnam, I learned to respect the power of information. I became acutely aware of information's power to kill, as well as to save lives. Using military intelligence to kill no longer makes sense to me. Today, I prefer to use information to give life, not take it. As an information officer, I was also faced with information overload. While at war, the amount of information we had to process was staggering. Very quickly, we had to learn how to sort, categorize, discard, and process tremendous amounts of information from multiple and varied sources. If we didn't, we or others could die. Classifying information. To handle information overload, the military puts a great amount of effort into classifying information. Without classification, all information is equal and virtually worthless. As an information officer in Vietnam, I learned to classify information according to a set of characteristics. 1. Time. In war and in business, information can be useful 1 minute and obsolete the next. War is fluid, always moving. So is business and investing. Enemy troops can be one place today and 100 miles away tomorrow. In business, a business advantage can be priceless today and worthless tomorrow. 2. Credibility. We had to know who the information came from. Were our sources credible and reliable? Unfortunately, in the world of money, most people get their financial information from people they work with or salespeople, people who are struggling for money as well. They may be good, honest people, but they are not credible or reliable sources of financial information. 3. Classification. In the military, I learned to sort information into categories. For example, top-secret information was only available to those with top-secret clearances. In the world of business and investing, top-secret or classified information is known as insider information. When the average investor hears the term, he or she thinks of illegal information, and sometimes it is. Insider information is illegal when a person receives information from someone inside a public company and uses it to buy or sell that company's shares. In reality, all information is inside information. A more important question is, how far from the inside are you? By the time a person hears a hot tip about a company's new product or news that a company is in trouble, people on the inside and close to the inside have already traded on that information. The battle has already been won, and the average investor has lost. Let me make it clear that I do not encourage or condone illegal insider trading on information. The distinction I want to make is about the importance of being on the inside and getting close to the information. One of the reasons I love being an entrepreneur and a real estate investor is because I am a legal insider who can trade on inside information. Since I am not a public company, I can also freely tell my friends what I know and how I am investing. In the stock market, professionals know that amateurs trade on ancient history. That is how professionals make their money. They make money from amateurs. An example is Mr. Average, an investor who gets up, reads the newspaper over a cup of coffee, and notices a news release from his favorite public company. He then calls his broker or goes online to make his trade. Even though the information may only be a few hours old, Mr. Average is already in a losing position. Mr. Average is late to the party because he was never invited. He is not on the inside. He is an outsider. One of the main reasons Rich Dad encouraged me to develop my financial intelligence is so I could have access to inside information. The closer to the inside your information, the richer you become. 4. Relative information. Watching battlefield information change day by day, we as information officers were able to interpret past and present information to forecast future information. For example, if we knew that enemy troops were in one position on Tuesday, another position on Wednesday, and another position on Thursday, we could begin to predict where they were going and what their objectives might be. In other words, we had to know how information related to other information. In the world of business and investing, this past, present, and future information gathering is known as watching the trends. 5. Deceptive information. In war, the enemy would often try to deceive us by sending deceptive information. They occasionally did this by using diversionary tactics. For example, they might move a large number of troops and equipment, making a lot of noise and dust, just to distract us from their real motives and objectives. Or they allowed us to capture one of their troops who provided erroneous information. Or they used a spy, someone we thought was on our side, to provide us with inaccurate information. The pump and dump. Business and investing are rampant with deceptive information. An entrepreneur and investor must be constantly vigilant and on guard against deceptive information. For example, many times a financial expert will tell you something and then do the opposite. This person may go on television and say he is bullish on a stock and is buying it. This bit of information causes other people to buy the stock, driving the stock price up. Once the price is up, the person who recommended the stock sells and takes a huge profit. This is known as the pump and dump. The sleight of hand. Another form of deception is known as the sleight of hand, a technique named after a magic trick. When a magician taps on his top hat, your eyes are drawn to the hat and away from what he is doing with his other hand behind his back. In business, consumers are often deceived the same way. For example, a box of cereal may boldly say, low fat. A consumer worried about gaining weight thinks this is a good cereal for them. Upon closer inspection of the fine print, however, you find the cereal is low in fat but excessively high in sugar. In investing, a mutual fund may advertise, highest returns of all funds. What the headline fails to state is that none of the other funds made any money and neither did their fund. It's like saying, I caught the biggest minnow. Classifying information to become richer. There are a number of lessons I learned in the military about classifying information that are applicable to business. Lesson number 1, facts versus opinions. The key to military intelligence is to know the difference between facts and opinions. The same is true for financial intelligence. One of the reasons so many people think investing is risky is because they do not know the difference between facts and opinions. A few examples of opinions are: when someone says the shares of a company are going to go up, it's an opinion because it is about a future event. When someone says a person's net worth is $1 million, it's an opinion because most valuations are opinions. If a person says he is very successful, this is an opinion because the definition of success is relative. Lesson number 2, insane solutions. An insane solution occurs when a person uses information that is an opinion as a fact. In war, this can kill you. In business, it can ruin you. For example, question, why did you buy that house when you knew you couldn't afford it? Answer, I bought it because my broker said it was going to go up in value. I thought that I could buy the house, live in it, and then sell it for a profit, which would solve my money problems. Question, why did you marry him even after you knew he was a womanizing lazy bum? Answer, well, he was so cute. I was afraid I would lose him. I did not want anyone else to steal him from me. So even though I knew he fooled around and did not like to work, I thought that after we got married and had kids, I could change him. Question: Why did you stay at a job you hated for so many years? Answer: I thought I might get promoted. Question: Why do you invest in those mutual funds? Answer: Because my supervisor told me to. She said it was a good investment. Lesson number 3: Risky actions. In war, if you didn't verify information and acted on it blindly, you risked death. A risky investor invests based on opinions. Unfortunately, this describes most investors. Since most investors invest for capital gains, their investment decision is based upon opinions about the future. Many investors invest in mutual funds based upon the opinion that the stock market goes up 8% to 10% per year. If the opinion is wrong, they lose. A smart investor knows the difference between facts and opinions. Generally, a person who invests for capital gains is investing on an opinion. A cash flow investor invests for facts. If possible, a smart investor will invest using both opinion and facts, and invest for both cash flow and capital gains. If you are investing in stocks, mutual funds, real estate, or business, ask yourself if the information you are basing your decision on is fact or opinion. Lesson number 4: Control over the asset. One important bit of information I want is how much control I have. In the previous chapter on Financial IQ number 4, Leveraging Your Money, I stated that it was important to invest with control before leverage. If I do not have control, I do not use much leverage. I control my asset value by controlling my rents. My asset value is not based upon a market appraisal, which is an opinion 99% of the time. The reason bankers often ask for a large down payment on a property is simply because they do not trust the appraised value. Of course, this practice went out the window when credit became cheap. With easy credit and cheap money, housing prices skyrocketed as fools rushed in after fool's gold. More buyers meant prices went up. As prices went up, real estate appraisals went up. As appraisals went up, families felt rich because they thought their home went up in value. Many took out home equity loans based upon their new appraised valuations. They bought new cars, vacation homes, took cruises, and went shopping. Then a rip appeared in the balloon, a tiny tear known as a problem with subprime mortgages. As the tiny tear keeps ripping, the balloon starts floating back to earth. This is the problem with using an opinion, capital gains, rather than a fact, cash flow, as the basis of valuation. This is true not only for real estate, but for all asset classes. This is why when seeking financial information I need to know if the information is a fact or an opinion. Financial insanity is caused when opinions are mistaken for facts. Fools rush in. There are 2 songs worth humming to yourself the next time you are about to make an investment decision: Fools Rush In by Johnny Mercer and Rube Bloom, and The Gambler by Don Schlitz and sung by Kenny Rogers. The line I love from The Gambler is, "You never count your money when you're sitting at the table." When someone says, "My net worth is," or "My home is appraised at," I know I'm talking to a gambler, a person counting his or her money while sitting at the table. My rich dad said, "The reason you do not count your money while you're sitting at the table is because as long as you are at the table, your money does not belong to you. The moment you step away from the table, the money in your pocket is your money and you can count it." Today, millions of workers with retirement accounts are counting their money while sitting at the table. Since most investors invest in paper assets and for capital gains, most invest without control and invest upon the hope that opinions become facts. That is very risky. This does not mean a smart investor only invests upon the facts. A smart investor is a person who invests with both opinions and facts. A smart investor knows that facts and opinions can be valuable bits of information. Simply said, a fact is something that is proved by verification of physical proof. An opinion is something that may or may not be based upon a fact. In other words, an opinion might be a fact, but it remains an opinion until verified. As my good friend and business partner Ken McElroy says, trust, but verify. Lesson number 5, what are the rules? Rules and laws are very important types of information. Many people get into trouble simply because they do not know the rules, ignore the rules, or break the rules. Personally, I never liked rules. In Vietnam, I liked them even less. One of the things I hated was that we fought according to one set of rules and the enemy fought according to another. One rule I found ridiculous in war was the rule that we could not pursue the enemy across borders. The enemy would fight close to the border and then escape across it for safety. There were many times we had to break off a fight because the VC crossed back into Laos. Another rule I did not like was that I had to wear a uniform, but the enemy did not. One of the hardest things about fighting was not having the information on who was an enemy and who was not. A uniform would provide that information. Rules increase asset value. It was my rich dad who changed my attitude towards rules. He said, if there are no rules, there is no asset. Explaining further, he said, in a neighborhood where the rules are broken, crime is high and property values go down. He also said, if you play sports and there is no referee to enforce the rules, the game turns into chaos. If you drive on the highway and police do not enforce the rules, people die. This is why rules are important. Rules can make a person very rich or very poor. This is why information on rules is so important. Not too long ago, the executives of Enron broke the rules, the company disappeared, workers lost their jobs, and investors lost their money. In the world of investing, different assets have different rules. One reason I do not like mutual funds is because I do not like the rules. I have no control. I prefer the rules of real estate, which allow me to make more money and legally pay less in taxes. If I applied the rules of real estate to mutual funds, I would go to jail. For people who want to be rich, having good accountants and lawyers is important. Today, there are so many laws, rules, and regulations that it is impossible for any one person to know or understand them all. While hiring an attorney or accountant may seem expensive, the pain they can save and money they can make for you can be much greater than the fees you pay them. Remember two things: rules provide a valuable source of information about how the game of money is played. And without rules, assets decline in value. Lesson number 6, Trends. A trend is developed when an investor takes information from a set of facts and then forms an opinion. Let me tell you a story that had a major impact on my life. In late 1972, the North Vietnamese Army, NVA, crossed the Demilitarized Zone, DMZ. The NVA was on its way to take Saigon, known today as Ho Chi Minh City. The first major city south of the DMZ was Quang Tri. We knew that if we did not stop them there, the war was lost. As we began to lose the battle for Quang Tri, I noticed some different message traffic. One bit of information was that the South Vietnamese people were trading their currency, the Vietnamese piastre, for gold leaf. I thought this piece of obscure information was interesting. As stated throughout this book, the US dollar stopped being money and became a currency in 1971. In 1973, while in Vietnam, I directly observed the change in the rules of money via the information received about the panic in the South Vietnamese people's lives. They knew the war was lost and they were on the losing side. In 1971, gold was pegged at $35 an ounce. In 1973, I watched its price go up past $80 an ounce. As the North Vietnamese began their march south, fear was approaching a panic level. The rich who sided with the US were getting ready to run. Instead of clinging to the piastre or US dollars, they were buying all the gold they could get their hands on. One intelligence report I received stated, confidence lost. People ready to flee. Trading dollars and piastres for gold. Sitting in the top secret room, I realized that people wanted gold. I assumed they knew gold would buy them passage to another country. I could feel their anguish. They knew that gold could save their lives. I knew the facts. The US was losing the war. The enemy was taking ground. Internationally, the dollar was dropping and gold was going up in price. From the intelligence report, I knew the South Vietnamese people were panicking and dumping their currency to buy gold. To me, this trend was an investment opportunity. I used it to form an opinion. A few days later, a friend and I flew north, just behind enemy lines, hoping to buy some gold. Our opinion was the Vietnamese gold miners would be desperate to sell to us their gold since the NVA had just overrun their village. Our opinion was the miners would jump at the opportunity to take our US dollars. Our opinion was we would be in a good position to buy gold at a discount. Because of our opinion, based upon a few facts, we were willing to break a few rules and risk our lives just to make a few dollars. Instead of making a killing, I was nearly killed. Instead of buying gold at a discount, I learned a valuable lesson about gold and currencies. That day I found out that the price of gold really was the same price all over the world. On that day, the price was about $82 an ounce. I found out that regardless of whether I was buying gold in US territory or NVA territory, its price was the same. Standing behind enemy lines, hoping to buy gold at a lower price, is a perfect example of becoming smart by being stupid. I was getting an MBA in international finance by standing in front of the bamboo hut sales office for the mine, arguing with a red-toothed old woman, stained from chewing betel nuts. Although I did not ask, I sincerely doubt if this woman was a Harvard graduate. I doubt if she had any formal education at all, but she was a great teacher. Even though she did not seem to be well educated, or dressed for success, she knew her stuff when it came to the value and price of gold. She was financially intelligent and tough as nails. She was not going to let a couple of young American pilots sweet-talk her out of her gold with rapidly declining US dollars. To this day, I vividly remember standing in front of her, arguing for a $5 discount. I was willing to pay $77, not the world price of $82. Instead of taking our money, she just kept shaking her head and chewing on her betel nuts. She knew the price. She knew the local and geopolitical economic forces in the world. She was informed, she was tuned in, she was cool, and she was in no hurry to sell her gold. She knew the trend was on her side and not on ours, and that there were people far more desperate for her gold than two pilots trying to make a few bucks. Once it dawned on me that she was not going to budge, I said silently to myself, I'm dead. Today I am going to die, standing behind enemy lines, asking for a $5 discount. No one will find us. No one will ever know what happened to us. We will be missing in action and we aren't even in any action. I won't be killed for a noble cause. I'll be killed trying to shave a few dollars off the price of an international commodity. I will die because I am cheap and stupid. If I stand here any longer, I will be shot in the back, arguing with this woman for a discount. I'm so stupid that I deserve to die. The trend is your friend. There were 3 lessons I learned that day. One was the power of global markets. A global market means the price is the same all over the world. Gold is priced in international markets. Real estate is priced in a local market. The old woman won because she had information from both the global and the local markets. She won because she had better information and higher intelligence. Today, I understand that I need to know what information is important both locally and globally. Today, I love real estate because it is an asset more dependent on local information than on global information. With real estate, I can be the expert in my small area. With local information, I can be smarter than the big institutional investors in New York, London, Hong Kong, or Tokyo. Just as David beat Goliath, a small investor with superior information and intelligence can beat the giant. The second lesson I learned that day was the power of trends. If I had better understood trends and the price of gold, I would have made a lot of money without risking my life behind enemy lines. I did not need to go behind enemy lines to invest. I did not need to ask for a discount. All I had to do was invest with the trend. I could have gone to a coin shop in any town in the world and bought gold for the same price. By 1979, the trend had carried gold to nearly $800 an ounce. I did not have to risk my life. If I had trusted the trend, I would have made a lot of money. I did not need a discount to make money. The third and most valuable lesson that day was that information is just information. Intelligence is the ability to take information and make it meaningful. The old woman with red teeth had the same information I had. Yet her intelligence provided her understanding and meaning I did not have. She was a seasoned player. She knew the game. I was the new kid, a new player in an ancient game. When the markets crashed and people panicked on August 9, 2007, I thought of that old woman. The first thing I did was check the trends. Instead of joining the crowd and going into panic mode, I simply kept my fear in check and refocused on the trends in the market, not on its ups or downs. I re-verified the facts and formed my own opinion about the future. I was looking for information on the actions taken by the central banks. Once again, they were printing more funny money rather than solving the problem. When I learned the facts, that international central banks were injecting cash into the crashing markets, I knew my opinion that the purchasing power of the dollar would continue to trend down was still sound. Today, instead of diversifying, I prefer to focus on a few small assets, notice a trend, and invest with the trend. Since I know a trend can reverse and change direction, I do not blindly invest for the long term. The information age is about change, and I need to be flexible, not a robot. Some of the trends I am investing in today are trends in oil. As you know, the more China, India, and Eastern Europe become westernized, the more the demand for oil goes up. Even with the rush to find alternative sources of power, oil will continue to be a primary source of power for years to come. As much as I do not like the environmental damage oil causes, the harsh reality is we all use it, even the most devoted environmentalists. I believe the long-term trend for the price of oil is up, possibly as high as $200 a barrel in the near future. This high price will have serious repercussions upon the world economy, which will later lead to other trends worth following as alternative energy technology, such as solar power, makes advances. Trends in silver. I believe silver is the best investment in 2007. I believe it is a better investment than oil. There are two reasons I say this. The first reason is because silver is consumable industrial metal. This means it's used up. Silver is the metal of choice for electronics. It is used in computers, cell phones, television sets, and other gadgets. It is estimated that 95% of all silver is already consumed. It is becoming scarcer. Gold is different. It is estimated that 95% of all gold ever found is still around. Instead of being consumed as silver is, gold is hoarded. In many ways, this makes silver more valuable than gold. The second reason is because silver is also a precious metal, a form of money. As the dollar drops in purchasing power, more people will look for anything that represents real money or at least holds its value. As I write, silver is very cheap when compared to gold. It is approximately $13 an ounce while gold is approximately $600 an ounce. Historically, gold has been only 14 times the price of silver, which means if silver were $10 an ounce, gold would be trading at $140 an ounce. At today's prices, gold and silver are trading at a differential of 50. To me, based on historical trends and the fact that silver is a consumable metal, it has a greater opportunity to go up in price. About a year ago, many stock exchanges made silver exchange-traded funds, ETFs, available for the investor who did not want to hoard silver coins and bars or invest in silver mining stock. The silver ETF made it easier for investors to invest in silver. A silver ETF is like the old US money, a piece of paper backed by silver, known as a silver certificate. The difference is an ETF can go up and down with the fluctuations in the world price of silver. I believe the addition of the silver ETF means the world is getting ready to start hoarding more and more silver as the purchasing power of world currencies continues to go down. That silver is a consumable and precious metal makes it the investment opportunity of the decade. The reports are that there is less than 300 million ounces of silver left on Earth. This means that the world may run out of it by the year 2020. Because of this, a few silver bugs feel that silver will become as expensive as gold in a few years. I do not think it will go that high. Yet, due to the supply and demand trends, I believe silver is a once-in-a-lifetime opportunity. Today it's a cheap, low-risk investment anyone in the Western world can afford. That is why I watch the trends and purchase silver anytime the silver market drops in price. Of course I could be wrong, so it is best to do your own research and find your own information before investing in this trend. Trends in housing. One of the reasons for the high price of commodities is that the world needs and wants more housing. For example, demand for concrete in China caused a shortage of concrete in the US, which caused the price of concrete to skyrocket. One of the reasons I love investing in apartment houses is that, rich or poor, people will pay for a roof over their head. In America, the population is expected to grow from 300 million to over 400 million in the next 2 decades. So I believe the price of housing will continue to trend up. As real estate becomes more expensive and difficult to afford, and as wages come down, I believe these trends will cause more people to be renters. One of the reasons Kim and I did not panic during the August 9, 2007 crash is because we rent out real estate for cash flow. We do not sell real estate. People who invest for capital gains are people who buy to sell real estate. When the subprime mortgage market collapsed, sellers panicked. People who invested for cash flow, those who rent property to others, didn't panic. In fact, they saw opportunity. In down markets, there are more renters than buyers, so a crash is generally good for landlords but not sellers. The old woman chewing on betel nuts and selling gold knew that panic was going to make her rich. The trend was her friend. People who rent their property know that the trend is their friend. For those who sell property, or are counting on their property to appreciate in value, the short-term trends may work against them. Instead of prices going up, they will probably come down or remain flat. The boom is over for sellers and just beginning for landlords. Demography is destiny. A very valuable source of information is demographics. As the saying goes, demography is destiny. In other words, just watch people, as I did in Vietnam, and you'll know which way to invest. Once I knew that when people panic they buy commodities with their currency, I had very valuable information for basing my opinions on trends. As gold went below $400 an ounce, I started to buy a little and began buying a lot when it hit $275 an ounce. Then the price began to head back up. In other words, I followed the trend down and bought a lot once the trend reversed. One of the reasons I like gold and silver is because there is always a market for it. It is relatively liquid, and if I need cash, I can get cash pretty quickly. Less liquidity, more information. In real estate, the trend is a large percentage of baby boomers retiring to Arizona and Nevada. So I invest in those states. Due to the loss of jobs in Detroit, people are moving out of Detroit, which is pushing housing prices and rents down. It will be a number of years before that trend changes. Since real estate is much less liquid than gold, silver, and stocks, I need to be much more cognizant of trends. After August 9, 2007, many homeowners, flippers, and real estate developers with overpriced condos are finding it hard to become liquid again. Instead of selling to get out, all most can do is watch helplessly as the value of their real estate sinks into the sunset. The lesson is, the less liquid an investment, the more trend information you need. Many people bought high and now are faced with selling low. An astute investor knows how to follow trends in order to buy low and sell high. The financial bird of prey. Every time I see developers' construction cranes sitting on high-rise condos, I know the end of the trend is near. Whenever you see construction cranes, aka birds of prey, sitting on the skyline, you know the boom is about to bust. It means that the cycle has peaked, and, generally, there is nowhere to go but down. The next time you see more than 2 construction cranes on the skyline, start selling any piece of real estate you do not want. History and cycles. A final thought on trends is the importance of history and cycles. Having survived a number of up and down markets, I have learned a lot from history. There is one historical financial trend I believe is worth watching. That trend is the 20-year cycle between stocks and commodities. As a person who sailed for an oil company and flew helicopters in search of gold, I became curious about why the prices of commodities went up as stock prices came down. A few years ago, I came across a book written by one of my favorite financial authors, Jim Rogers, entitled Hot Commodities. Rogers discovered that stock prices went up for 20 years at the same time as commodity prices came down. For example, from 1960 to 1980, just as I was coming of age, commodity prices such as oil and gold were rising. In 1980, oil, gold, silver, and real estate prices came down rapidly as stock prices started climbing. Between 1980 and 2000, the stock market was the place to be, and oil, gold, and silver were dogs. While the commodity market was down, I was buying all the oil, gold, silver, and real estate I could. On schedule, in 2000, at the height of the dot-com boom, share prices dropped and commodity prices came roaring back up. If history repeats, this means that commodities will come down in 2020 and stocks will be the market to be in again. Obviously, I do not have a crystal ball. But history does seem to repeat, and I am old enough to have seen some reruns. If you would like more information on how a world-class investor such as Jim Rogers analyzes trends, I recommend you read Hot Commodities, or any other book he has written. He is a brilliant investor and writer who is an astute observer of trends. Always remember, the trend is your friend. If you ignore the trend, the birds of prey will pick your bones clean. In conclusion, ultimately, it is not the asset that makes you rich. Information makes you rich or poor. For example, if I had bought gold at $800 an ounce in 1979, I would still be waiting to make my money back today. Given how much the dollar has dropped in purchasing power, that means I would have to wait till gold reached $1,500 to break even today. The same is true for any asset. For example, in real estate most investors lose money because of inadequate information and intelligence. That is why when someone asks me, is real estate a good investment? My reply is, I don't know. Are you a good investor? Most businesses fail because of a lack of good business information and intelligence rather than from a lack of money. When people ask me, I have a great idea for a new business, and I'm looking for some money, would you be interested in investing in my new company? My reply is, I don't know. How many successful businesses have you started? As it turned out, volunteering to fight in Vietnam was one of the smartest things I ever did. If I had not volunteered, I would never have met that old woman chewing betel nuts. That day, standing behind enemy lines, she taught me a very important lesson. She won because she knew the price of gold had nothing to do with the value of gold. By understanding value, she knew why people were buying and why gold was important to them. That day I learned that it is not the asset that makes you rich, it is information and intelligence that makes you rich. If I can lose money investing in gold, which is real money, I can lose money in anything. That day I vowed to become smarter because she taught me that it is information and intelligence that makes me rich, not the gold. Chapter 8. The integrity of money. Integrity is an interesting word. I have heard it used in many different ways and in different contexts. I believe it is one of the more misused, confused, and abused words in the English language. Many times I have heard someone say, he has no integrity, or if they had any integrity, they would be more successful. Someone else might say, that house has integrity of design. Before discussing the integrity of money, I think it best I give my definition of integrity. Webster's offers 3 definitions for integrity. They are: 1. Soundness, an unimpaired condition. 2. Incorruptibility, firm adherence to a code of especially moral or artistic values. 3. Completeness, the quality or state of being complete or undivided. The integrity of a car. All 3 definitions are required to discuss money and integrity. To better illustrate, I use the example of the integrity of an automobile. An automobile is made up of systems: the brake system, fuel system, electrical system, hydraulic system, and so on. If the systems are not operating in integrity, the car will not function, it will not be sound. For example, if the fuel system is corrupted, the entire car stops. The integrity of the car is compromised and broken. The car is not whole. The integrity of health and wealth. A similar example can be made with the human body. Some of the systems of the body are the arterial system, respiratory system, nervous system, skeletal system, digestive system, and so on. If the integrity of the human body system is not sound, corrupted with clogged arteries for instance, health declines and disease or death soon follows. Just as health can break down from a literal lack of integrity, so can wealth be compromised by a lack of integrity. Instead of disease or death, which comes from a breakdown in the body's integrity, symptoms of a lack of financial integrity are low income, crippling taxes, high expenses, excessive debt, bankruptcy, foreclosure, increased crime, violence, sadness, and despair. Earlier, I listed 5 different financial intelligences. Once again they are. Financial IQ number 1, making more money. Financial IQ number 2, protecting your money. Financial IQ number 3, budgeting your money. Financial IQ number 4, leveraging your money. Financial IQ number 5, improving your financial information. The integrity of all 5 intelligences is required if a person wants to grow rich, stay rich, and pass his or her wealth on for generations. Missing one or more of the financial intelligences is like someone who doesn't know how to drive attempting to drive a car that has brakes without pads and water in the gas line. When a person is struggling financially, one or more of these financial intelligences is out of whack, financial integrity is not sound, and the person is not complete. For example, I have a friend who earns a lot of money as a manager of a small business. Her problem is she has no protection against taxes, plus she does not budget well, spends impulsively to buy clothes and take vacations. Her leverage is a big home because she thinks real estate only goes up in price. She gets her financial advice from her husband and his financial planner. Her husband is a great guy but, like his wife, he has similar challenges with all 5 financial intelligences. They are nice people, educated, honest, church-going, and hardworking. They enjoy life and raise great kids. The problem is a lack of financial integrity. This lack of financial integrity shows up as worry about borrowing the equity out of their home to pay off credit card bills, affording a college education for their 3 kids, and having enough for retirement. These are typical money problems, symptoms of a lack of financial integrity. The problem is they don't think they have a problem. They get up every day, send the kids off to school, and go to work. They come home, play with the kids, help them with their homework, watch a little TV, and go to bed. They know something is wrong, but they'd rather not find out what. They are hoping something will change. Financial report card. Like most people, my friends don't have personal financial statements. They don't even know what financial statements are or why they are important. Like most college graduates, my friends left school not knowing the difference between a credit application, a credit score, and a financial statement. Without a personal financial statement, however, they do not know where they are financially, what might be wrong, and where they might be out of financial integrity. Without a financial statement and the 5 financial intelligences, it may be difficult to determine what is wrong and what needs to be corrected. In my opinion, this is where the lack of integrity begins. It begins in our school system, with financial IQ number 5, improving your financial information. In 1974, when businesses began requiring employees to invest for their retirement, the school system should have added or improved financial education in the curriculum. This lack of financial education in our schools is sending shock waves through the financial integrity of the world. A reflection of financial integrity. As my rich dad said, my banker has never asked me for my report card. The reason bankers don't ask for an academic report card is because they are looking for financial intelligence, not academic intelligence. This is why they ask for a financial statement. A financial statement is a reflection of your financial integrity. It is the equivalent of your financial report card. Bankers are looking for answers that relate to the 5 financial intelligences. Obviously, they want to know how smart people are at making money, protecting their money, budgeting their money, leveraging their money, and how informed they are. A financial statement will give the bank the information it is looking for. Out of financial integrity. If a person is out of financial integrity, as shown by excessive debt, not budgeting well, spending more than he or she earns, foreclosures, and bankruptcies, the banker will probably not want this person as a client. It is a matter of professional integrity. In 2007, with the crash of the credit markets, it became obvious that the credit, banking, and investment institutions have been out of financial integrity. Greed replaced sound lending practices. The economy cannot expand on credit alone. By failing to teach much about money and to expand financial intelligence in school, the system creates adults who are unprepared for our brave new world. Billions of adults across the planet do not have a personal financial statement, cannot read a business's financial statement, and do not know the financial condition of their country. This is a breakdown in educational integrity. Intrinsic value. Warren Buffett does not diversify. Instead, he looks for a company with intrinsic value, a company with financial integrity. He wants to know if the business has the 5 financial intelligences. In overly simplified terms, Buffett wants the answers to the following questions. 1. Can the business make more money? 2. Does the business have a protected niche? 3. Does the business budget its money and resources well? 4. Can the business be leveraged and expanded? 5. Is it run by a team of smart, well-informed people? In even simpler terms, intrinsic value means 1. Niche. This means the business has a core competence, something that will make money in good times and bad. Coca-Cola fits this requirement. People will always drink sugared water regardless if plain water is better for them. A big advantage Coca-Cola has is its trademark, which is protected by law. You may recall that financial intelligence number 2 is protection. In this case, Warren likes this product because it's a product that is a legally protected brand, not just a commodity. A well-recognized brand, protected and defended from pirates, increases Coca-Cola's intrinsic value. The brand Rich Dad is a trademark protected by law in every country we do business in. Being a brand gives my business greater intrinsic value. Many authors write books but fail to build a brand. As you know, Harry Potter is a mega brand. So is Donald Trump. If you are not a brand, you are a commodity. Brands have more intrinsic value, and to maintain this value, a brand must be true to its message and customers. A few years ago, a large mutual fund company approached me and asked if I would endorse its fund. Although the fee it would have paid me was very high, I turned the offer down. In my mind, endorsing a mutual fund would not be true to the Rich Dad brand. To me, it would have shown a lack of integrity, which would diminish the brand's intrinsic value. Besides, I couldn't do it with a straight face. 2. Leverage. This point separates the small business owners from the big business owners. For example, if I am a doctor, it is hard for me to leverage my value if my patients come only to see me. But if that same doctor invented a new cure or kind of medicine, then that doctor's medical intelligence can be leveraged via a product. The world is filled with small business owners and professionals who are not able to leverage because they are the product. Most employees fall into this category. They don't know how to leverage their services and trade time for dollars. Most of us know musicians who work hard but do not earn much money simply because they fail to leverage their talents. The world is filled with musicians who produce a CD, which is a form of leverage, but are not able to leverage the distribution and sale of their CD. This is why amateur programs such as American Idol are so popular. People who think they can sing want the leverage of national television, even if Simon criticizes them. 3. Expandability. Once a product or business can be leveraged, the next question Warren wants to know is, how far can the leverage be expanded? Warren loves Coca-Cola because its leverage is expandable throughout the world. Warren says, every time someone in the world drinks a Coke, I make a little money. When I wrote Rich Dad Poor Dad, the book was my leverage. Instead of my teaching in person, my book and my games could now do the teaching. The next task was to expand the product into different countries by printing the books and games in different languages. This was done by licensing the rights to produce Rich Dad products to businesses in different parts of the world. Instead of having my company print, inventory, and distribute my products, there are now publishers in 109 countries that do that for me. This is my example of leverage and then expandability. 4. Predictability. What Warren Buffett wants to know is how predictable revenue is. He doesn't want peaks and valleys in income. He wants to know that come rain or shine, the money will come in like clockwork. One of the reasons I love my apartment houses is that rain or shine, the money comes in. I am not worried about the price of real estate going up or coming down. I want my money coming in 24/7 from all over the world and from my apartment houses. This is why Warren Buffett does not diversify. Instead, he focuses on a business's intrinsic value. Recognizing intrinsic value requires the 5 financial intelligences. When a business has intrinsic value, the business has integrity. When a business has integrity, it has a better chance to grow and remain profitable, regardless of changing economic conditions. Before investing in a company, a professional investor looks at the business's financial statement. The professional investor is looking for business integrity. The same is true when a real estate investor buys an apartment house. Knowing about the internal rate of return, IRR, is intrinsic value applied to real estate. The problem for most people, due to a lack of financial education in school and not being able to read a financial statement, is that they don't know if the company or real estate they are investing in has financial integrity and intrinsic value. The language of business. Warren Buffett says, accounting is the language of business. If you do not know the language, it's hard to tell if the business has integrity. The reason the Rich Dad Company produces our cash flow games for adults and children is because we strongly believe that financial intelligence and being able to speak the language of business are crucial in a world of greed and questionable integrity. Government financial integrity. Governments also require the 5 financial intelligences. Governments need to make money, protect their money, budget their money, leverage their money, and seek the best financial information. If a government operates in integrity, the government and its people flourish. If a government is out of integrity, the government and its people struggle and grow poorer. Higher taxes and excessive debt are signs that the US government is struggling with financial integrity. In 1971, when Nixon took the US off the gold standard and got the world to accept our currency as the reserve currency of the world, the US went out of financial integrity. Today, rather than being the richest country in the world, we are the biggest debtor nation in the world. While many people have become very rich because of this change in the rules of money, me included, millions more have fallen behind financially. The financial gap is growing wider and becoming dangerous. The problem for America began at financial intelligence number 3, budgeting your money. When America began to import more than it exported, we changed the rules of money and began accumulating trillions of dollars of debt instead of solving the problem, which would have been the intelligent thing to do. When looking at financial intelligence number 4, it becomes apparent the US government doesn't leverage money, instead it leverages debt. Today, the richest people in the world are in debt to the poorest people in the world. Talk about being out of integrity. The US went out of financial integrity when it asked the world to accept a dollar backed by the full faith and credit of the US government. No one likes investing in the US and seeing the value of the dollar drop. When the world demands the money back, it will be financial intelligence number 2, protection from predators, that will be tested. I believe that the US will become a giant predator, possibly defaulting on some of its loans and its promises to senior citizens for health care and social security. It will allow inflation to destroy workers' earnings and raise taxes on the young. To me, this is out of integrity. The current way for the US government to increase financial intelligence number 1, making more money, is by raising taxes, printing more money, borrowing more money, fighting a new war, and not paying a few bills. Obviously, this will cause many more financial problems, which could have been avoided if the earlier problems had been solved in the first place. The age of integrity. History does repeat. Our leaders and educators have been aware of what happens when governments violate the integrity of money. This has happened before. Copernicus in 1517 wrote that inflation was one of the scourges that debilitate kingdoms. In 1776, Adam Smith said inflation causes the most pernicious subversion of the fortunes of private people. Smith's warning came true more recently in Germany, when Hitler rose to power, after the Weimar government subverted the integrity of its currency. The only reason the US and world public isn't finding out about the difference between money and currency is because our school systems simply are out of educational integrity, failing to produce a financially literate populace. Personally, I believe we as a people, a nation, and the world are all heading for a perfect storm. After being out of integrity for so long, I believe the financial, political, environmental, and spiritual forces will demand that the pendulum swing in the other direction. Exactly what will happen, I do not know. It may have already started. Unfortunately, the super-rich, those who benefit the most from the current system, will be least affected by the coming financial upheavals. It is the rest of us that will feel the forces of nature and be required to do our best to battle the storm, and the poor will suffer the most. The good news is that the problems ahead will make us smarter if we take them on with courage, and do not run from them. Inside every problem is a gem of wisdom, a gem that makes us smarter, stronger, and able to do better regardless of economic conditions. Even more good news is that a few national governments are beginning to implement financial education courses into their educational systems. I predict that the country that has the best financial education will lead the world into a new era of economic prosperity. After all, this is the information age. Increase your intrinsic value. In the meantime, it is important for each of us to prepare for the potential storm ahead. My recommendations are: 1. Put your house in order. Just like a sailor preparing his boat for a storm, start making your financial boat more seaworthy. Take a look at the 5 intelligences and ask yourself which intelligence you need to work on now. Which one needs the most work? Which one is your biggest problem? Focus on that one and address it now. Do not attempt to take all 5 on at once. That would be overwhelming. I believe you will find that all 5 are related, so by focusing on one, you will ultimately improve all 5 intelligences. Then take your time, learning a little every day. Always remember, no golfer became a professional in one day. Not even Tiger Woods. By increasing your 5 financial intelligences, you are increasing your financial integrity and your own intrinsic value. If you are not sure what to do, please do not be afraid or ashamed to ask for help. In the next chapter on finding your financial genius, I write about how much I depend upon smart people for help. No one is above needing help. 2. Invest in assets with intrinsic value. Take another look at some of the criteria Warren Buffett uses to establish a business's intrinsic value. Then for practice, start asking yourself which businesses around you meet the requirements. Even if you do not invest, this is a great exercise for increasing your financial IQ. Intrinsic value of real estate. One of the reasons I like real estate is because I am able to see, touch, and control much of the property's intrinsic value. But always remember, most real estate is not a good investment. A great exercise, regardless if you have money, is to look at a number of properties and analyze their intrinsic value. One of the beauties of real estate is creativity. For example, I can use creative financing, creative improvements, or creative ways to increase the value of the property. Creativity is not as much an advantage when picking a stock or buying mutual funds. But in real estate, creativity plus integrity can make you very rich. 3. Batten down the hatches. As they taught us at the U.S. Merchant Marine Academy, when a storm approaches, it is time to batten down the hatches. This means to protect the integrity of the ship. In my few years of going to sea, I had the opportunity to sail through 4 typhoons in the Pacific. Today, I can still see monstrous waves, a mountain of water, crashing over the entire ship. I can see, feel, and hear the ship creaking and straining, doing its best to maintain structural integrity and come out from under the wave. I am glad the engineers designed a great ship, and that the ship's crew was trained and ready to take on the storms. Chaos is going to increase as the industrial age ends and the information age takes control. As oil goes up in price, the dollar drops, China and India start producing cars and planes, manufacturing jobs disappear, corporations move offshore, baby boomers expect to be taken care of by the government, terrorism increases, wars we cannot afford are fought, and debt that has to be repaid is increased, problems previously swept under the rug will be exposed. In the information age, information such as the 5 financial intelligences will be your greatest of assets. I believe the financial integrity of the world is going to be challenged as never before in history. I believe this because there has been too much greed, misinformation, and corruption running our businesses, governments, and schools. In August of 2007, when the credit markets crashed, I believe we were touching the ragged outer limits of the brewing storm. The eye of the storm is still a few years away. Take this time to prepare for the ride of your life. Be brave and get smart because it's going to get exciting. It's going to be a great time to become even richer and become even smarter. But you've got to be brave, and you've got to develop your financial genius. Chapter 9. Developing your financial genius. I didn't know I wasn't smart until I went to school. For 17 years, from kindergarten all the way through college, school was a struggle. I was always labeled an average student. No matter which class I was in, there were always kids who were smarter, more gifted, and faster learners than me. School seemed easy for the smart kids. School was tough for me. The only A I ever received was in woodshop because I loved working with my hands. I built a boat for my class project while my classmates were making salad bowls for their moms. I also didn't know I was poor until I went to school. When I was 9 years old, my family moved across town, and I went to a school for rich kids. Interestingly, there were 2 elementary schools directly across the street from each other. On one side of the street was Union School. On the other side was Riverside School. Both were public schools, one school for the rich and the other for the working class. Originally, Union School was for the children of the sugar plantation union workers, hence the school's name. Riverside was the school for the children of sugar plantation owners and managers. I attended Riverside School because the house our family lived in happened to be on the side of the street next to the river. Even though I was only 9, I was aware that my classmates at Riverside School lived at a higher standard of living than my family. Many of my rich classmates lived in an isolated community connected by a bridge across the river. Every time I crossed that bridge to play with my friends, I knew I was crossing into a different world. On their side of the bridge, my classmates lived in stately plantation manor homes. On my side of the bridge, homes were a lot less stately. The home we lived in was a home built for plantation workers. My classmates' parents owned their homes. My parents rented. Some of my classmates even had more than one home, many having beach houses. When my family went to the beach, we went to a public beach park. My classmates played at the yacht club or the country club. I worked at the country club. Although rich, my classmates and their families were not snobs. They were friendly people involved in the community. I spent a lot of time at my friends' beach homes, on their boats, and flying in their planes. They did not flaunt their wealth. They shared it. To them, being rich seemed natural, not special. It was a lifestyle and a standard of living. Their lifestyle was not that big a deal to them. It was I who thought their lifestyle was a big deal, sometimes feeling uncomfortable, sometimes out of place, and acutely aware of the standard of living that separated us. At the age of 12, my rich friends went off to private schools, and I continued on through public high school with the kids who went to Union School. I also didn't know I was a geek until I went to school. In high school, all the girls I wanted to date wanted nothing to do with me. I was not cool. The popular girls were interested in the bad boys who were older, belonged to a gang, and owned a car. Although I was a starting player on the football team and a surfer, I was not cool, not a bad boy, and didn't own a car. I was shy, fat, and drove around in our family's beige-colored station wagon. Definitely not cool. In 1974, as I was getting out of the Marine Corps at the age of 27, I knew I wanted to be rich, drive fast cars, and date beautiful women. Even though I had grown up, lost my baby fat, and gotten taller and stronger, in my mind I was still the shy fat guy without much money. I knew what I wanted. I just didn't know how I was going to get there. I knew I wanted to be an entrepreneur and invest in real estate, but I had no money and no skills. The more I thought about it and compared the life I wanted with what I had, the more I realized that my school teachers were correct. I was average. I had no great skills or talent. I was not smart. If I was going to be rich, I needed to find a way to be at least above my means in every way. Don't live below your means. Financial experts advise people to live below their means and diversify. To many people this sounds like smart advice. The problem with following this advice is that you wind up average because it is average advice. It is not bad advice. It's just average financial advice. Besides, who wants to live below their means? In high school, students begin focusing on their academic strengths and taking courses with an eye towards high-paying future careers. Kids are constantly pushed to be smart, study hard, and get good grades. After graduating from college, many go on to graduate school, narrowing career choices to becoming lawyers, doctors, accountants, and MBAs. Many doctors, after years of grueling medical school, go on for additional training to become specialists such as surgeons or internists. Artistic students become artists in clay, oils, watercolors, commercial graphics, and music. Gifted student athletes prepare for professional careers in football, tennis, basketball, or golf. In fact, if you go to athletic events, many parents scream for blood, demanding their kids play and their team wins. Nobody wants to play on an average team. Most of us know that to be successful in school and to have successful careers we need to do our best to be the best. We need to focus and study. We need to specialize. Yet when it comes to money, people are advised to diversify instead of specialize and live below their means rather than live at a higher standard of living. When I got out of the Marine Corps, I did not want to get an average job and live below my means. To me, living below your means is how below average people live. I did not want to drive an average car or live in an average neighborhood. I also knew that diversifying would cause my return on investment to be below average. I knew I needed to focus if I wanted a higher standard of living, a standard of living like my classmates who lived across the bridge. When I looked at the world I was about to re-enter after 4 years of military school and 5 years in the Marines, I noticed that most people worked hard to be above average professionally but were below average financially. I decided the best way to beat the A students, the rich kids, the teachers who labeled me average, and the girls who were not interested in me was to become rich. I was not angry with them. I was just tired of being average. I realized I could become richer than most people because when it came to money, most people were following below-average financial strategies and advice. Why do experts recommend diversification? As Warren Buffett says, diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. Buffett also said about money managers, full-time professionals in other fields, let's say dentists, bring a lot to the layman. But in aggregate, people get nothing for their money from professional money managers. I believe that when many recommend diversification, it is simply a protection against their ignorance. I suspect Buffett is saying that it's below-average financial advice from below-average advisors for below-average investors. Warren Buffett has a different financial strategy. He doesn't diversify. He focuses. He looks for a great business at a great price. He doesn't buy a lot of businesses and pray one of them does well. He doesn't want average returns, or to play the stock market. He likes to control the company, but not run the company. When Warren talks about investing, his key words are intrinsic value, not diversification. One reason financial advisors recommend diversification is that they cannot find great companies. They do not have control, and most don't know how to run a business. They are employees, not entrepreneurs like Warren. Smart guys fail. On August 24, 2007, after the market crash, the Wall Street Journal ran a story about how quantitative funds, quants, supposedly managed by some of the smartest guys on Wall Street, all lost money. Justin Lahart, how the quant playbook failed. In other words, a student received FS. The article states, even if they don't share the same statistical models, quant funds share similar approaches to the market. They are schooled in the same statistical methods, pore over the same academic papers, and use the same historical data. As a result, they can easily come to similar conclusions about how to invest. In other words, Wall Street hires academic geniuses, students and graduates of the world's best business schools who use sophisticated computer models to invest billions of dollars, and they all come to the same answer. When their models say buy, they all buy the same stocks, causing a boom, and when the models say sell, they sell en masse, crashing the market. This is not financial intelligence. Not diversified, but thinking they are diversified. I have two very smart classmates who both went on to graduate from Stanford University with PhDs. Both have high-paying jobs, one with a bank and the other with an oil company. After the stock market crashed following 9/11, both lost a lot of money even though both were diversified. Over the years, I talked to them individually. I asked about their investment strategy. Both said, I invested in a well-diversified portfolio of stocks, bonds, and mutual funds. Although I did not say it, I wanted to point out to them that they were not really diversified. Instead of being diversified, they were 100% invested in paper assets, primarily the stock market. They were not in investment-grade real estate, privately held businesses, or commodities such as oil production. When the market went down, it all came down. They were not diversified, but they thought they were. They had above-average academic IQs, but below-average financial IQs. Finding your genius. I built and rebuilt several businesses from 1974 to 1984. I was determined to become an entrepreneur. Just like a baby who stands and falls a number of times before learning to walk, I stood and fell a number of times before walking as an entrepreneur. I did this because I wanted to learn to be an insider, not an outsider. From 1984 to 1994, I became an educational entrepreneur because I became interested in how people learn. Although I disliked school, I enjoyed learning. Also, I wanted to know why I always felt stupid in class. During those 10 years, Kim and I built an education company that taught entrepreneurship and investing from our offices in Australia, Canada, New Zealand, Singapore, and the US. During this period of time I did things differently, almost the opposite of the way traditional schools teach. Instead of creating an environment where only 1 or 2 students were smart, I created an environment where everyone could feel smart and learn. Instead of competing, the class cooperated. Instead of having students listen to me lecture, I created different games to teach specific subjects. Instead of being bored, adult students were actively challenged and participated. I went on to develop my educational board game Cashflow from what I learned as an entrepreneurial educator, the first game to teach both accounting and investing at the same time. As you may know, accounting can be the most boring subject on earth and investing the most frightening. By combining the 2 subjects into one game, learning became challenging and fun. A person could play the game 1,000 times and still learn something new about accounting, investing, and themselves. The game was officially launched in 1996. As I learned more about the human mind and how we learn, I found out a number of things about our school system that were disturbing. I found out that our current system of teaching actually damages a child's brain. In other words, even an A student can be slowed up by the educational system. The more I studied and practiced different teaching techniques in my classes, the more I began to find the answers I was looking for, and I found why I had constantly been labeled stupid or, at best, average. Multiple intelligences. Through my research I discovered the book Frames of Mind, The Theory of Multiple Intelligences by Howard Gardner. His work was mind-expanding and validating. He teaches that there are 7 intelligences. 1. Linguistic. 2. Logical mathematical. 3. Musical. 4. Bodily kinesthetic. 5. Spatial. 6. Interpersonal. 7. Intrapersonal. His book validated what I intrinsically knew. I simply didn't have the intelligences recognized by the school system, which are predominantly linguistic and logical mathematical. This is one of the reasons I failed English twice in high school. I could not write, spell, or punctuate. I am not linguistic, and I am not logical. In my freshman year at the Merchant Marine Academy, English became my favorite subject because I had a great teacher. If not for that teacher, I might not be an author today. My English teacher at the academy had great interpersonal skills, which is why he could relate to me. I respected him. Instead of talking down to me, he inspired me. We could speak person to person rather than teacher to student. In his class, I wanted to be smart, and I wanted to learn. Instead of another F in English, I received a B. I need security. Later, as a Marine in Vietnam, it was my intrapersonal intelligence that kept me alive. Intrapersonal intelligence is the ability to control your emotions and get the job done, even if the job is life-threatening. Many people are not successful financially because their intrapersonal intelligence is weak. People with limited intrapersonal intelligences often say, "I need job security," or "that sounds risky." These are examples of emotions doing the thinking, not intrapersonal intelligence. As I studied more about Gardner and his theory of multiple intelligences, I realized that the A students were those who had high linguistic and logical mathematical intelligences. Reading, writing, and math were easy for them but very difficult for me. I read and wrote slowly, and I only liked math if I was measuring something like my boat or my money. My intelligence strengths were spatial, bodily kinesthetic, and intrapersonal, which is why I doodled in class, built a boat, and was not threatened or motivated when teachers told me I wouldn't get a good job if I didn't get good grades. At this time, you may want to ask yourself, of the 7 intelligences, which are you strongest at? You may want to list them in order, 1 being the highest and 7 being the lowest. I encourage you to read Dr. Gardner's book. 3 Parts of the Brain. Albert Einstein is credited with saying, imagination is more important than knowledge. As an entrepreneurial educator, I did a lot of research on the different parts of the brain. Boiling it all down to overly simplified terms, we have 3 basic parts to our brain, pictured below. 1. The left brain. Generally, this part of the brain is used for reading, writing, speaking, and logic. Kids who do well in school have well-developed left brains. From Gardner's work on multiple intelligences, the left brain would be most associated with linguistic, logical, mathematical, and interpersonal intelligences. Writer, scientist, lawyer, accountant, and school teacher are professions for such people. 2. The right brain. This part of the brain is often associated with pictures, art, music, and other more nonlinear relationships, with creativity and imagination. From Gardner's work, musical and spatial intelligences would be most associated with the right brain. Designer, architect, and musician are professions for people with these dominant intelligences. 3. The subconscious brain. This is the most powerful of the 3 brains because it includes the old brain, often called the primitive brain. It's the primitive brain that is most like an animal's brain. It does not think, but rather reacts, fights, flees, or freezes. From Gardner's work, the intrapersonal intelligence would most relate to the subconscious mind. In my opinion, it is a person's intrapersonal intelligence that ultimately determines if they are a success or failure in life, love, health, and money. This is because the subconscious mind is the most powerful part of the brain, especially in pressure situations. The subconscious mind also affects our bodily actions via bodily kinesthetic intelligence. For example, in the game of golf, pressure may cause a golfer to choke and miss an easy putt. Subconsciously, a person may freeze and not take action out of fear of making a mistake, or stay at a job for security rather than the love of the work. People with high intrapersonal intelligence have the ability to control the subconscious brain's desire to fight, flee, or freeze. Instead of flee, they may decide the best thing to do is freeze. If frozen, they may choose to fight. The point is, they have the intelligence to choose the appropriate subconscious response. If angry, they can speak calmly. If afraid, they can confront their fear. People think differently when their subconscious is controlled by fear. If people are fearful, they may say, I can't do that. What if I fail? Or, that's risky. Compare that to a person who is in a fight state subconsciously, who might say, I'll show them. I'll get that deal just to prove I can do it. Learning to choose your subconscious state of mind before thinking and making decisions is very important. When I was in Vietnam, I felt better, flew better, and was more confident when I subconsciously chose to fight. When I was in a fleeing or fearful state, my thoughts were fearful. So choose your subconscious state of mind before using your left and right brains. Professions requiring tremendous control under stress are best for people with strong intrapersonal intelligence. For example, police officers, emergency room nurses and doctors, firefighters, and soldiers require high intrapersonal intelligence. I would say entrepreneurs require a high level of this intelligence. Which brain controls your money? The reason I became curious about the brain and how it works is because I wondered why so many people say one thing and then do another. For example, I might ask a person, do you want to be rich? Most people will say from their logical left brain, yes. I really want to be rich. The problem is not found in their logical left brain. The problem is the subconscious brain saying, not you. You'll never be rich, or how can you be rich, you don't have any money. In most cases, it's the subconscious fear of failing that holds people back. It is this fear of failing that teachers use to motivate people in school. I remember my teachers saying to me, if you don't get good grades, you won't get a good job. Later in life, when the A students who got the good jobs want to make career changes, their fear holds them prisoner. For example, I have a friend who is an attorney, an A student from Harvard, who wants to change, but he can't. He is afraid of doing something new for fear of failing and not making enough money. He says to me, "I've been an attorney for so long I don't know what else to do. Who else will pay me what I am earning?" He has a brilliant left brain, an underdeveloped right brain, and an out-of-control subconscious brain. Again, the subconscious brain is the most powerful of the three brains. The subconscious mind is so powerful that it controls our addictions. For example, most smokers want to quit. You can logically explain to their left brain all the harmful effects of smoking and show their right brain horrifying pictures of lung cancer. But if the subconscious mind wants to smoke, the person smokes. In many ways the subconscious brain controls your life, regardless if you are an A or F student. For most people, when it comes to money, there is a battle of the brains going on inside of them. It is this conflict that causes many people to live below their means when in reality they want to improve their standard of living and to be rich. As a teacher of entrepreneurship and money, I find many people, even well-educated ones, who are addicted to being poor. Something in their brain keeps them poor. Instead of turning everything they touch to gold, everything they touch turns to lead. Battle of the brains. As a teacher, this battle of the brains made me curious. I was puzzled by the conflict between a person's logical and illogical mind. I realized that true education isn't simply a matter of teaching students to read, write, and memorize answers. I realized that to be effective, true education had to align the power of all three brains. Instead of the three brains working against each other, they had to work together. If a person could align and develop all three brains, he or she had a greater chance of success in the real world. The problem with traditional education is that it focuses on only one part of the brain, the left brain. In other words, you could be a left brain genius and a subconscious moron. You can know what to do in your left brain and in your subconscious brain be terrified of actually doing it. Worst of all, many people leave school, fully able to read, write, and do math, but are terrified of failing and seek security instead of opportunity in the real world. They are taught to value knowledge over imagination, and over the ability to integrate all three parts of the brain. After years of striving to be the best, these people are told by financial experts to diversify and live below their means. To a fearful subconscious brain, this advice sounds intelligent and logical. For years these people then turned over a portion of their paycheck every month to their financial experts with the hopes that they know what they are doing. At the same time, the richest investor in the world, Warren Buffett, says, diversification is a protection against ignorance. And it is. A world ruled by left-brainers. The world is run by left-brain people. The problem with left-brain people is they think there is only one brain and only one intelligence. Many are not aware of the other parts of the brain and the possibility of other types of intelligences. When you ask a highly educated left-brain person for the definition of intelligence, he or she replies, "If you agree with me, you are intelligent. If you don't, you're an idiot." In the world of money, these left-brain people believe making money is a by-the-numbers formula, a mathematical equation. This is why when the market crashed, many funds crashed in unison. The funds are run by academic geniuses all following the same formula. Here's another quote from the August 24, 2007, Wall Street Journal article on quant funds, Justin Lahart, How the Quant Playbook Failed. A number of quant funds, which use statistical models to find winning trading strategies, reported heavy losses this month. In many cases, the managers pointed their fingers at other quantitative hedge funds, essentially saying they all owned many of the same stocks and their models told them to sell at the same time, driving down the share prices, hurting everyone in the process. In other words, the A students used their linguistic and logical mathematical left brains to invest in the stock market and came up with the same answers, just like in school. And who pays the price for the losses? Not the A students. They have steady paychecks. They are employees, not investors. Learning to win using your whole brain. Warren Buffett once said, "You have to think for yourself." It always amazes me how high IQ people mindlessly imitate. As an educational entrepreneur, I began teaching students to think outside the box and to create rather than imitate. I was surprised at how frightening this teaching process was for many of my students. Most had been so frightened into needing job security, a magic formula for investing, and avoiding mistakes that breaking the bonds of that fear was the hardest part of my job. These were smart, successful, well-educated people who wanted to make changes. They were not poor, unsuccessful, and uneducated. My job as a teacher was to show them how to use their primary intelligences and all three brains to win financially. I often called my business programs Learning to Win Using Your Whole Brain. To get people's attention, I would often say, A students work for the C students, and B students work for the government. Obviously this did not make the A students happy, but they got over it once I explained the logic behind my findings. Poor and middle-class dialects. Neuroscientists have recently discovered that the brain has mirror neurons. Many of these scientists believe this discovery is more important than the discovery of DNA. A neuromirror, in overly simple terms, is the equivalent of monkey see, monkey do, or birds of a feather flock together. That is, our brains are programmed to imitate what we see others do. It explains why quant fund managers invest in the same stocks, why poor people stay poor even though they earn a lot of money, and why a child raised in England will speak a different dialect of English with a different accent than a child born in the US or Australia. Mirror neurons of dialect and accent limit the scope of our world and who we associate with. Many kids have a tough time leaving Hawaii because their dialect of English is Pidgin English. Kids from Hawaii who speak Pidgin often go to mainland schools with big Hawaiian clubs so they can feel comfortable. Many of the kids at Union School spoke Pidgin. The kids from Riverside School were forbidden to speak it. I believe this made a tremendous difference in my life, and why I went to school in New York and not at the University of Hawaii. In the world of business and investing, poor people speak a poor person's dialect. Instead of using the language of business and investing, they say such things as government programs, welfare, and assistance. The middle class has a different dialect. They say, diversify and live below your means. Buffett, the richest investor in the world, says, it's not that I want money. It's the fun of making money and watching it grow. Again, this is an example of a different English dialect reflecting a different mirror neuron brain. Every group speaks a different dialect. For example, when golfers get together they speak a completely different form of English. When they talk about a birdie, they are not talking about shooting wild birds on the golf course. Wherever you go in the world, if one golfer says to another golfer, I shot a birdie, every golfer knows this person scored one below par, which means it was above average play. In the same way, simply put, rich people speak a different dialect. It's a matter of different brains and different mirror neurons. That is why crossing the bridge at age 9 was life-changing and why I do not live below my means or diversify. This is why even when I was broke, I did not drive cheap cars, wear cheap clothes, or live in a cheap neighborhood. It's a matter of mirror neurons and of standard of living. Today, neuroscientists believe that mirror neurons are the most powerful learning parts of our brains. In the classroom, it explains why some students are teachers' pets. Since most classrooms are led by left-brain people, they tend to favor the kids with the same intelligences. On the flip side, these teachers tend not to like kids who are artistic, musical, creative, physical learners, or not easily intimidated. By the time college comes around, most of the kids who are not linguistic and logical mathematical are gone. They have been labeled and eliminated. Sadly, the kids who are eliminated often leave school feeling stupid. Imagine if that happens to you at an early age. How does this label affect the rest of your life? In an experiment conducted by Harvard professor Robert Rosenthal and Lenore Jacobson in 1966, teachers were told that certain kids in their classes were geniuses even though they were not. In almost all cases, those kids received exceptionally high grades. In other words, researchers found that it was the teacher's perception of the child's intelligence that had the greatest influence on a child's learning. In the world of investing, this is called a bias. In race relations it is known as a prejudice. This is an example of the impact of mirror neurons. In simple terms, mirror neurons mean our brains are like television transmitters and receivers. Even though we are not physically talking to one another, our brains are communicating at very deep levels. For example, when we walk into a room, most of us can immediately sense who likes us and who doesn't, even though nothing is said. This is the worst part. I learned that if I did not feel good about myself, people did not feel good about me. In many instances, another person is only sending back what I am broadcasting. In other words, if I think I am a loser, other people will think of me as a loser. The good news is that you and I can change their perception of us by changing our perceptions of ourselves. This can be done by adapting our mirror neurons. It is not easy, but it can be done. For example, if I had not changed my perception of myself, I would never have met and married a beautiful woman like Kim. Someone like Donald Trump wouldn't be my friend, and I wouldn't be financially secure today. If I had not consciously changed my perception, I would probably still be a shy, fat, poor kid speaking pidgin English. Even though I graduated from a very good school, I left not feeling smart. I left feeling that there were people I would never be as smart as. I was always average. When I interviewed for jobs, the first questions asked were what school I went to and if I had a master's degree. If I had a master's degree, I had a better chance of being hired. Once again, even though I was in the business world, I was still in a classroom, in a world dominated by left-brain intelligence. In 1974, while working at Xerox, promising the company that I would get my MBA, I began researching the brain and different ways of learning and teaching. I was looking for a way to win on my terms, not on their terms. Being raised in a family of school teachers, I realized their measure of success was the school a person attended and how many advanced degrees he or she had. In the world of big business, it was pretty much the same thing. In most major corporations, employers want the pedigree of prestige that comes with advanced degrees from recognized schools. In other words, graduates from Ivy League schools are better than graduates of state universities, who are better than graduates of community colleges. In the world of big business, the school you attended can give you a better job, a better title, and a better paycheck. That is the measure of success. Being around my rich dad, I realized his measure of success was how much money he made, the people he spent time with, the freedom to work or not work, and how many jobs he provided. I realized I had better decide whose measure of success I wanted to base my life on. Since I did not think I could win at my poor dad's game of school and big business, I decided I had a better chance of winning at my rich dad's game. That is when my real education began. I decided to follow in my rich dad's footsteps as an entrepreneur and real estate investor. I knew I had a better chance in those areas because most A students are employees, looking for high-paying jobs and investing in paper assets such as stocks, bonds, and mutual funds. Since I was a C student, I realized that I needed to use all three of my brains, not just my left brain, if I wanted to learn to win. The questions for you are: what is your measurement of success? Where do you have the best chance of winning? Is your brain being trained to win? Are your brains working together or are they working against you? 2 disadvantages. Over the years, I discovered that there were 2 disadvantages people had when it came to money. They are: 1. Our schools do not teach much about money. Even an A student leaves school knowing very little. On top of that, via the recently discovered science of mirror neurons, most of us learn about money from people who also are not financially intelligent. This is why so many people have middle-class aspirations, i.e., living below your means, saving money, and staying out of debt. 2. Our schools do not strengthen the subconscious mind. In fact, rather than educate, schools depend on fear to motivate, threaten rather than teach, imitate rather than innovate, punish mistakes rather than encourage, play it safe rather than think bigger, and say what a person wants to hear rather than what a person needs to hear. Due to these 2 factors, many people buy when they should sell, save when they should spend when they should save, are fearful when they should be brave, and are brave when they should be fearful. Examples of such non-controlled, irrational, financially foolish, subconscious brain behaviors are: 1. All the quant funds selling at the same time, crashing the market because they were all invested in the same stocks. They were selling when they should have been buying. Panic comes from the subconscious brain. Copying or mimicking comes from the fear of being different, so they do the same thing instead of being creative and risking thinking differently. 2. When people receive a raise or come into some money, they often spend it because they feel good, instead of paying off bad debt. I know of a gentleman who inherited nearly $1 million from his parents. Immediately he bought a big big house and 2 new cars on credit. Instead of getting out of bad debt, his elation got him into greater debt. Today he is out of money and trying to save his house. 3. When the economy turns down, the sales prevention department of many businesses takes control. When sales drop, most business cut back on advertising, promotion, and sales staff. Rather than save, a business needs to spend. In a bad economy, the business needs to spend more on advertising and promotions, hire more sales representatives, offer more sales incentives, and be more creative. In other words, be more right-brained, and communicate more. Instead of the sales acquisition department taking the lead, the sales prevention department takes over. The sales prevention department of most companies is made up of left-brain people such as accountants, attorneys, and salaried employees, generally people with strong left brains but terrified subconscious brains. When the sales prevention department takes over, many employees lose their jobs. In my opinion, when times are tough, it is the sales prevention department that should shed a few employees. The subconscious brain thinks it's intelligent. The problem with the subconscious brain is that it can be your greatest friend or your worst enemy. It takes a person with higher intelligence to step back and objectively determine which brain is talking, the friend or the enemy. When it comes to highly emotional subjects such as money, sex, religion, and politics, it requires a highly evolved intellect to be able to detach, expand, listen objectively, and then think clearly with both left and right brains. The problem with the subconscious brain is it's reactive, not intelligent, and not able to weigh pros and cons. Arguing with an idiot. It is impossible to be logical with a person speaking from his or her subconscious brain because the subconscious brain isn't logical. It can't think. It can only react. The problem is, when people are speaking via their subconscious brain, they still think they are being logical and intelligent. For example, when I suggest that a business person spend instead of save during a recession, in most cases the subconscious brain takes over and begins giving the business person the logical reasons why he or she needs to cut back, to lay off employees, and to go into a money-saving mode. To most business people this is logical and intelligent. They do not want to learn more. Their mind is made up. The brain is closed to new ideas. If you push the issue, the mind becomes defensive. The walls go up, and instead of fleeing, they want to fight. They want to defend their decision and be right. Instead of learning, they become idiots. The problem with arguing with an idiot is that there are soon 2 idiots, you and the person you're arguing with. One of the reasons poor people remain poor is because they have a poor person's subconscious mind. When I talk to people who are struggling financially, many will defend their right to be poor. They say such things as, "I'd rather be happy than rich," or "You have to be a crook to be rich." If you argue with them in an attempt to open their minds to new ideas, their subconscious brain often becomes more closed, more self-righteous. Soon there are 2 idiots having a friendly argument. A similar event occurs with many employees and high-paid executives who like their job but want to do something else. Instead of doing what they want, their subconscious mind comes up with logical and reasonable reasons why they cannot. When informed about the high taxes they are paying as high-paid employees, they may reply, "Well, you have to pay taxes." If pressed and informed about better investments, higher returns, and less in taxes, they may reply, "That sounds risky." They close their mind to new possibilities because of fear. If you argue, there are again 2 idiots. To change your life, change your environment. In my research on education and how we learn, it became very clear that environment was the most powerful teacher of all. This is why the latest validation by neuroscientists discovering mirror neurons in the brain is so important. Science is finally finding out what many of us already knew: to change your life, first change your approach. Most of us know that if we want to lose weight, we have a better chance of success by going to a gym rather than going to a restaurant. If we want to study, it might be better to study in the quiet of a library rather than trying to read while driving a car, which I have seen people doing. If we want to relax, we leave work and go to the beach or climb a mountain. And if you want to become rich, you need to find an environment that is conducive to becoming richer, an environment that strengthens all 3 brains. Ironically, work and school are not those environments for most people. The power of environments. If you want to grow richer and more successful, it becomes critical that you find an environment that allows all three of your brains to grow and gives them the time to develop. By 1974, I realized that I would never be hired to work for an A student. For example, a doctor or a lawyer would never hire me because doctors and lawyers need academically and professionally smart people around them. A doctor does not want a clumsy nurse, nor does a lawyer want an incompetent paralegal. Since I was a C student, I needed to find a way to get a student to work for me. That is when I decided to be like my rich dad and become an entrepreneur and real estate investor, and not like my poor dad, who was an A student and a school teacher. I chose to become an entrepreneur and real estate investor because I am a slow learner and I knew I needed time to develop. I was not looking to become rich quickly. I was looking for an environment that suited me, where I could spend a lot of time learning slowly. Another important reason for being an entrepreneur was that I could surround myself with smart people. I know I am not linguistic or mathematical, so I need these people as part of my team. I am still an average writer, average at math, and terrible with details. When it came to sports, I knew I was better at team sports such as football, rugby, and rowing. I am not good at individual sports such as golf or tennis. Knowing this about myself, it seemed more logical for me to surround myself with smart people who also like being on a team. I found out the hard way that many smart people are not good on teams, which is why they excelled at school, taking tests on their own. In my world of business, I take tests every day, but not as an individual. In my world of business, I take my tests and solve my problems with a team of smart people. In other words, my genius comes out on a team. For others, such as Tiger Woods, genius comes out through the individual. The question is, are you better off as an individual or on a team? Do it your way. This does not mean I am saying that you need to be an entrepreneur or real estate investor. I'm not telling you to do what I do. What I am saying is that you may want to consider a learning environment that improves your chances of winning financially. Find your own environment and your own way to financial success. For example, if you think you can become a pro golfer, then you obviously need to spend much more time at the golf course engaging the mirror neurons in your brain to learn with the best golfers you can find. The reason the discovery of mirror neurons in the brain is significant to me is because ever since 1974 I have spent most of my time with entrepreneurs and real estate investors. I am constantly seeking opportunities to do business with great entrepreneurs and real estate investors. This is why writing a book with Donald Trump in 2006 was so important to me. More than the book, it was a great opportunity to learn via mirror neurons by spending time with a great man. Spending time with him took my perspective on business, life, and standards of living to a whole new level, almost as much as crossing the bridge to my rich friends' homes when I was 9 years old. Finding your environment. Today, many business schools ask me to come and speak to their entrepreneurship classes. A common question the students ask related to financial intelligence, number 1, making more money, is, how do I find investors? Or how do I raise capital? I understand the question because it was a question that haunted me when I left the security of Xerox and became an entrepreneur. I had no money and no one wanted to invest with me. The big venture capital firms were not knocking on my door. My answer to the business school students is, you just do it. You do it because you have to do it. If you don't do it, you are out of business. Today, even though I have enough money, all I do is raise capital. That is all my friend Donald Trump does. His job is to raise capital. That is job number 1 of an entrepreneur. As entrepreneurs, we raise capital from 3 groups of people. They are your customers, investors, and employees. Your job as an entrepreneur is to get your customers to buy your products. If you can get customers to give you money by buying your products, your investors will give you lots of money. And if you have employees, your job is to get them to produce and make at least 10 times more money than you pay them. If you cannot get your employees to produce at least 10 times more than you pay them, you are out of business, and if you are out of business, you do not need to raise any more money. Obviously, this is not the answer most MBA students are looking for. Most are looking for the magic formula, the secret recipe, the quick business plan to riches. Many business school instructors squirm because most of them teach entrepreneurship, but are not entrepreneurs. Most still need a steady job, a paycheck, and are hoping for tenure. Again, it is the effect of our brain's mirror neurons not agreeing with opposing thoughts that causes them to squirm. Many business schools would rather bring in CEOs to lecture who are employees rather than entrepreneurs. The eyes tell the truth. While sharing my views on what it takes to raise capital, I watch the students' eyes. In 70 to 90% of them I see fear. Their eyes become glassy and their breathing becomes shallow. Blood has flowed from the left and right brains and into the primitive brain, the oldest part of the subconscious brain. Conversely, about 10% of the class chuckle and smile. They like my answer. Their eyes become brighter and they become excited. They know they can win. They know they can beat their classmates. They know they can become entrepreneurs. Despite an environment that thrives on fear of failure, all three of their brains are firing in alignment. Developing the three parts of the brain. For those of you who have played my cash flow game, you may recall that to win the game requires a lot of left brain financial knowledge and right brain creativity. Since it is only a game being played with fake money, the fear of failing or losing money is greatly reduced, leaving the subconscious mind more or less neutral. Once a person understands the game, the subconscious brain shifts from fear to excitement and the joy of winning. Learning becomes fun and exciting. All three brains are being educated and developing. New possibilities are opening for an expanded whole brain. The cone of learning. In 2005, Arizona State University did a study on the viability of my game for teaching accounting and investing to business school students. Their findings were extremely positive and favorable, concluding that students actually learn faster and retain knowledge longer than when they learned in other ways. The university also introduced me to the cone of learning, pictured below. The second best way to learn. As you can tell from the chart above, the worst way to learn is by reading and the second worst way is by hearing a lecture, the most popular ways to teach in traditional schools. At the top of the cone is doing the real thing. When I told the MBA students to just go out and do it, many froze. Obviously there is a gap between reading, lecture, and surviving in the real world. The Arizona State University study pointed out that just below real life is simulations or games. The study confirmed the cone of learning and that our game was the second best way to learn about the left-brained logic combined with the right-brained creativity of money management, accounting, and investing. Instead of being subconsciously fearful, learning was fun and motivating. Students felt more self-confidence, more empowered, eager to learn more, and better able to use what they had learned. The university's findings were consistent with my findings as an educational entrepreneur. I found that by focusing on Howard Gardner's fourth intelligence, bodily kinesthetic, students learned more, learned faster, had more fun, and retained the information longer. Instead of just lectures, we played different games to make different points. I encouraged playing and making mistakes, and then we debriefed once the game was over. The learning was powerful because games involve all three brains. Many times, participants became upset, angry, or sad. They did not like the mistakes they made. Some blamed the game or other participants. These emotions are all part of the learning process, in my classes and in real life. My job as the instructor was to guide the participant away from blame and emotions and into learning the lesson the game was teaching. Once participants got their personal lessons from the game, some broke out laughing, saying, "I didn't realize I do the same thing in real life." Once there is cognition, a relationship between behavior in the game and behavior in real life, the participant has the opportunity to make changes if he or she wants to. At that moment of cognition, the aha of life, all three brains are working together. Once that occurs, the participant is often open to learning more and growing. One great success story occurred recently at a boys and girls club in a very poor part of Phoenix. A team from my company set up a cash flow club. Once again, teaching financial intelligence via a game was powerful, profound, and life-changing. One particular participant was a student who was labeled learning disabled by the school system and placed in a class for slow learners. After playing the cash flow game a number of times with his friends, he slowly began to improve his reading and math skills. Today, he's in a regular class. This is the power of coordinating all three parts of the brain in a cooperative, peer-to-peer learning environment. Change your environment. Change your life. As an educational entrepreneur, it became apparent to me that environment was the strongest teacher of all. I realized that I could teach and inform, yet if the participant went back to the same environment as before, the effect of what I taught was diminished. In other words, if the person went back to the job where mistakes were punished and creativity was suppressed, what I had taught him or her was of little value. The old environment won. There is an old proverb that goes, "If I knew where I was going to die, I would not go there." Today, I know there are millions of people in environments that are not the best for their learning, wealth, and personal development. Their work and home environments are not increasing their financial intelligence and wealth. Instead of becoming richer, they become prisoners of their offices and their homes. Instead of seeking success, most people live in environments that reward playing it safe, not making mistakes, but as Paul Tudor Jones says, one learns from mistakes, not successes. Finding your genius. For people to develop their genius, they need to find the environment that supports the development of their genius. For example, Tiger Woods' environment is the golf course. He would not have done well as a jockey. Donald Trump found his strength in the tough world of New York real estate. That environment challenged him, taught him a lot, and developed his skills. This is not an easy process. As you know, Tiger Woods works very hard at being a golf genius. Donald Trump works very hard at being a genius at real estate development. If you have ever seen the buildings he has developed in Manhattan and around the world, you know that it is easy to see his drive. Oprah survives and thrives in the very tough environment of television. One of the reasons many people do not develop their genius is simply because they are lazy. Many just go to work to collect a paycheck. It is easier for them to be average than to work hard at developing their genius. My questions to you are, what do you think your genius is and what environment is best for you to develop it? Another important question is, do you have the courage to change environments? Imagine your future, if you did. For many people the answers to these questions are I don't know, or simply no. For most people being comfortable is more important than finding and developing their genius. It is far easier to be average, work hard, collect a paycheck, save money, diversify in mutual funds, and live below their means. If this is you, then keep doing what you are doing. Every one of us is different. We all have different strengths and weaknesses. This is why I do not recommend that everyone do what I did. Even though it is pretty easy to be an entrepreneur, I know that being a rich entrepreneur is not easy. The world is filled with entrepreneurs who are average. The same is true with real estate. The world is filled with real estate investors who do not make much money. My point is this, we all have a unique talent or genius. If people want to become rich, maybe even super rich, they need to find an environment that allows them to develop and apply their genius. This is not easy, but it can be done if you are dedicated and have the drive to win. In the real world, dedication and drive are more valuable than good grades. Environments that make you rich. If you want to become richer, it is important to continually upgrade your environment. This is why I shake my head every time some expert recommends living below your means. By living below your means you continually live in a lesser environment. As a young boy, every time I crossed the bridge to my rich friend's neighborhood, my brain was absorbing what it is like to live at a higher standard of living, a standard I wanted to live at. My brain was looking for ways I could achieve such a standard of living. This does not mean running out and buying a big house, flashy cars, new clothes, and getting into piles of bad debt. What I mean is to consciously and intelligently challenge yourself to improve your standard of living by increasing your financial intelligence. The best way to increase your financial intelligence is by first finding the environment where your genius can grow and develop. That can be as simple as going to a library and reading a book by a person you want to be like, or by looking at magazines with pictures of stately homes. The first step is to consciously begin to stimulate your mirror neurons to the standard of living and to the people you want to be like. In summary, financially weak people are people who tend not to develop their intelligence. They seek easy environments and easy answers. These are people who get pushed around, pay too much in taxes, work hard, and live below their means. They may be smart, good, and academic, but without the financial development of all three brains, they will most likely remain weak financially. Success requires some degree of mental and physical toughness. If you can train your left brain to understand the subject, engage your right brain to come up with creative solutions, keep your subconscious brain excited rather than fearful, and then take action, while being willing to make mistakes and learn, you can create magic. You can develop your genius. Chapter 10. Developing your financial IQ. Some practical applications. This book has been about developing your financial intelligences and raising your financial IQ. As I wrote earlier, you need to have the integrity of all 5 financial intelligences to become rich and successful. I know this is easier said than done. Developing your 5 intelligences is a lifelong process, one that cannot be accomplished in a day or even a year. I am continually working on developing my intelligences, and I encourage you to do so as well. This chapter provides some practical ways to hone your financial IQ. Many financial advisors recommend investing for the long term. Most of them really mean for you to turn your money over to them so they can collect commissions for the long term. The problem with this advice is that you do not learn much, if anything at all. At the end of the long term, you are not necessarily financially smarter, and you have not developed your financial IQ. On top of that, most long-term investors invest in high-risk investments that offer low returns and very little control. Instead of blindly following your financial advisor's advice, you may want to consider investing in long-term transitional environments that strengthen all 3 brains and provide opportunities to strengthen your financial IQ. You should look for transitional environments that will develop all 3 of your brains and your genius in a practical way. Some examples of transitional environments are: 1. School. School is a transitional environment for most people. Taking classes is a great way to improve left and right brain functions. The problem with traditional schools is that they are not environments for developing the subconscious brain, the most powerful of the 3 brains. Most traditional schools magnify the mirror neurons of the fear of failing and the fear of making mistakes. 2. Church. I have noticed that there are 2 kinds of churches: churches that teach the love of God and churches that teach the fear of God. I do not know how effective fearing God can be, yet I think church is a great place to find spiritual strength, which strengthens the subconscious brain. Hopefully, with greater spiritual strength, a person will be better able to be more ethical, moral, and generous. 3. The military. The Marine Corps was a great environment for me to develop all 3 brains. Being a pilot required all 3 brains and all 7 intelligences, even musical intelligence. Often, we played rock and roll music to boost our courage as we flew into combat. Today, I believe I am a better entrepreneur, especially when losing money, because I learned to improve my intrapersonal intelligence and keep my fears under control. 4. Network marketing. Most network marketing companies are incredible learning environments because they offer training, support, business structure, and products, so you can focus on developing your sales skills and building your business. I recommend that anyone who wants to be an entrepreneur join a network marketing company for some of the best real-world, street-smart business training. These companies focus on developing all 3 brains, and especially strengthening the subconscious brain. Network marketing training programs are great for developing your interpersonal intelligence and your intrapersonal intelligence. Developing those 2 intelligences will change your life and increase your standard of living because they teach you to overcome the fear of other people and the fear of failing. The best thing about learning in the network marketing environment is that it is a supportive environment, not a fear-driven one as are schools and businesses. Instead of flunking you or firing you for below-average performance, most network marketing businesses will work to strengthen you for as long as you are willing to learn and grow. I know a number of people who spent 5 years with a network marketing business before finally breaking through their doubts and fears. Once they did that, the money poured in. 5. Business. There are basically 2 kinds of businesses, big and small. Big business can be a great place to develop all 3 brains, especially your subconscious brain. The pressure my friends in these big corporations handle is enormous. How they do it, I do not know. The mind games and back-office politics offer great opportunities to train your interpersonal and intrapersonal intelligences. For people who want to be entrepreneurs, taking a job with a small company can be a great learning environment. One advantage a small company has over a big company is that you can learn about all the different aspects of business. In my book Before You Quit Your Job, I describe the 8 essential parts to a business. By working in a small business, you have a better opportunity to learn all 8 and gain essential business experience. 6. Seminars. Traditional schools are important for people who want to become licensed professionals such as doctors, lawyers, and architects. They are also important for people who want to climb the corporate or government ladders where degrees from traditional accredited schools are required for promotions. Seminars, however, are great for people who want to be entrepreneurs or investors. Today there are seminars and conventions for every subject on earth. All you have to do is find the one that piques your interest. The Rich Dad Company has excellent seminars for people who want to become real estate professionals or learn to trade stocks. I am very proud of these programs because they are taught by instructors who practice what they teach. The more advanced courses are hands-on and learning is step-by-step. For example, you will go into neighborhoods and make real offers with real money. If you are in the land development course, you will work on actual land development projects. Most importantly, our courses are designed to educate and strengthen all 3 brains and have them work in unison. By focusing all 3 brains, your profits and chances of success improve. If you would like more information on our programs, simply go to richdad.com and take a few minutes to find what you need. 7. Coaching. Donald Trump and I were fortunate to have rich dads who were our coaches. For anyone who has ever played a team sport, you know how important a coach can be for a team's success. The Rich Dad Company also has a coaching division. It is staffed by professional coaches, who are not only great coaches but also practice what they coach. Rich Dad Coaching is for people who want one-on-one attention. If you would like more information on our coaching program, please go to richdad.com. As with all Rich Dad programs, a strong emphasis is put on educating all 3 brains. Now, if you are saying to yourself, how can I afford a coach? I don't have any money, or why do I need a coach? I'm perfect already. Think about this: when someone says, I can't afford it, or I don't need help, when he or she really does, it is the subconscious mind talking. This is exactly why the person needs a coach. A coach is essential for anyone who is ready to transition from point A to point B, from one environment to the next. If not for my rich dads coaching me for nearly 30 years, I would not be where I am today. Even today, I continue to have a number of coaches because I still have a subconscious mind that is not totally in alignment with my spirit. 8. Cash flow clubs. Today, there are thousands of cash flow clubs all over the world. These club leaders are volunteers who love creating a Rich Dad learning environment. Some clubs offer my official Rich Dad 10-step curriculum for those who want to increase their financial intelligence. Many clubs operate for free, a few charge a nominal fee to cover expenses. For more information, go to richdad.com and look for a cash flow club near you. Joining a club is a great way to meet like-minded people and activate the mirror neurons in your brain. You may also want to start your own cash flow club in your neighborhood, business, or church. 9. A download for you. On September 6, 2007, I did a video interview with Dr. Michael Carlton, MD, an expert on the brain and addictions. The title of the talk was, Can People Be Addicted to Being Poor? It was one of the best interviews I've ever had the pleasure of being a part of. In his talk, Dr. Carlton went into greater detail on how the brain works, and why some people are rich and some are poor. It is a matter of addictions. You may have your own copy of his talk by going to richdad.com and downloading it. I believe you will find his talk funny and extremely informative. This is our way of saying thank you to you for reading this book. These are examples of possible transitional environments. For me, the Marine Corps, Xerox, my own businesses, and real estate investing were where I learned to develop my genius. If you want to develop your genius, what environment is best for you? What does it take to be an entrepreneur? Most of us know that entrepreneurs are the richest people on earth. Some of the more famous entrepreneurs today are Richard Branson, Donald Trump, Oprah Winfrey, Steve Jobs, and Rupert Murdoch. There is an ongoing debate that asks, are entrepreneurs born or can entrepreneurs be developed? The question is raised because some people think it takes a special person or a certain magic to be an entrepreneur. To me, being an entrepreneur is not that big a deal. For example, there is a junior high school girl in my neighborhood who has a thriving babysitting business and hires classmates to work for her. She is an entrepreneur. Another young boy has a handyman business after school. He is an entrepreneur. What most kids have is no fear. For most adults, that's all they have. 2 characteristics of entrepreneurs. Today, there are millions of people who dream of quitting their job and become entrepreneurs, running their own business. The problem is, for most people, their dream is just a dream. It never becomes a reality. So the question is, why do so many fail to go for their dream of becoming an entrepreneur? The best answer to this age-old question comes from a friend of mine. He says, entrepreneurs have 2 characteristics, ignorance and courage. This simple assessment is profound. It explains so much more than just entrepreneurship. It explains why some people are rich and why most are not. For example, one of the reasons so many students are not rich is because they may be smart but they lack courage. There are many people who lack both knowledge and courage. A tale of 2 hairstylists. I have a friend who is a brilliant hairstylist. When it comes to making women look beautiful, he is a magician. For years, he's talked about opening his own salon. He has big plans, but sadly, he still remains small, running a single chair in a large salon, constantly at odds with the owner. Another friend has a wife who became tired of being a flight attendant. 2 years ago she quit her job and went to school to become a hairstylist. A month ago, she had a grand opening for her salon. It is a spectacular environment and she has attracted some of the best hairstylists to work there. When my older friend heard about her salon, he said, "How can she open a salon? She has no talent. She is not gifted. She wasn't trained in New York like I was. And besides, she doesn't have any experience. I give her a year and she's going to fail. She might fail." Statistics show that 90% of all businesses fail in the first 5 years. But the point of the story is the impact of ignorance and courage upon our lives. In this example, we have one hairstylist who is gifted but who lacks courage, and another hairstylist who lacks experience but has courage. In my opinion, it is this relationship between ignorance and courage that is the essence of life itself. In 1974, I didn't have a job, money, or much business experience. I couldn't live below my means because I didn't have any means to live below. I couldn't diversify because I had nothing to diversify. All I had was courage. In the real world, courage is more important than good grades. It takes courage to discover, develop, and donate your genius to the world. Always remember that your mind is infinite and your doubts are limiting. Ayn Rand, the author of Atlas Shrugged, said, "Wealth is the product of man's capacity to think." So if you are ready to change your life, find the environment that will allow all 3 of your brains to think and grow richer. And who knows, you might find your genius. Your feedback loop. No man is an island. We live in a world of feedback. When we climb on a bathroom scale, our weight is giving us feedback. If the scale says we are 10 pounds heavier, we may not like the feedback, especially if we are already 20 pounds overweight. When your doctor takes your blood pressure and sends your blood sample to a lab, your doctor is looking for feedback. Feedback is important. It can be a very important source of information about us and our environment. The problem is, if we do not like the feedback, our subconscious minds may block out, distort, diminish, or deny the importance of the information coming from feedback. One of the most enlightening lessons I learned from the Marine Corps was the importance of feedback. When I was messing up, the feedback was pretty intense and definitely not sugar-coated. When I worked with my rich dad, there was the same intensity of feedback. In doing our book together, I received very fast and blunt feedback from Donald Trump. If not for my military training, or working with my rich dad, I know I never could have worked with Donald. His feedback was quick, to the point, and direct. I know that if I had argued back, disagreed, or not listened to Donald's feedback, I would not be working with him, nor would I have learned as much. I mention this because today many of us work in environments where feedback is not allowed, not forthright, and not honest. Many schools and businesses are afraid to tell you what you need to hear for fear of being sued. Many friends and co-workers will speak behind your back because they lack the courage to speak to your face. This is not a healthy environment. It is a dysfunctional environment. A healthy environment is one that offers feedback. Life is constantly giving you priceless information if you are willing to receive it, and most of the time the feedback is free. Every time you open your pay envelope and see how much is lost to taxes, this is feedback. If your creditors are calling, demanding payment, this is feedback. If you are working harder and not earning enough, this is feedback. If you are spending more time at work and less time at home, this is feedback. If your kids are on drugs and being chased by the law, this is feedback. If your friends are all losers and like being losers, this is feedback. It is great information. The real world is trying to tell you something. Your standard of living is a great source of feedback. If you are living in a home that makes you feel poor, that is feedback. If you are driving a cheap car when you would rather be driving a Lamborghini, that is feedback. Standard of living is simply the standard you feel most at home with. It does not mean being comfortable, cheap, or compromising. Standard of living means you are in love with and proud of your home, friends, and possessions rather than envying someone else's standard of living. Again, this does not mean improving your standard by getting into debt. I'm talking about improving your standard of living by first finding a great environment to learn, getting smarter, and then growing richer. You do not need to go to a great school, have a great job, or read great books to receive some of the best information in the world. All you have to do is look at the world around you and listen to the feedback. There are 3 important things to know about feedback. 1. Have the courage to be open to feedback. If you want to improve, seek more feedback. This is why coaches and mentors are important to successful people. Successful people seek more feedback. 2. Offer feedback or advice only if it's asked for. Nothing infuriates people more than feedback they did not ask for, even if it's feedback they know they need. As that ancient bit of wisdom goes, don't teach pigs to sing. It wastes your time and it annoys the pig. 3. Con men will tell you what you want to hear rather than tell you what you need to hear. Con men prey on the mentally uninformed and emotionally weak. They will tune into where you are weak, and then they will craft a marketing message that matches that weakness. In the world of money, con men have gotten the masses to believe that diversification and living below your means is smart, even though the smartest investors such as Warren Buffett do not diversify and do not recommend living below your means. Buffett lives at his standard of living, which is very different than Donald Trump's standard of living. Warren Buffett lives in Omaha, Nebraska, and Donald Trump lives in New York City. The point is, both men have the means to live anywhere in the world and at any standard of living they want to live at. They are happy where they are. More important questions are: you living where you want to live and at the standard of living you want to live at? Are you diversifying and living below your means so that con men can live above their means? Are you associating with friends and people you want to be associated with? If you want to become healthier, smarter, richer, and happier, pay closer attention to your own feedback. It is offering you the most important information in the world. Regardless of whether you like your feedback or not, if you have the courage to listen to it and learn from it, you will succeed. Thank you for reading this book. Robert T. Kiyosaki. Robert Kiyosaki, author of Rich Dad Poor Dad, USA Today's #1 money book for 2 years running and the international runaway bestseller, is an investor, entrepreneur and educator whose perspectives on money and investing fly in the face of conventional wisdom. He has, virtually single-handedly, challenged and changed the way tens of millions, around the world, think about money. In communicating his point of view on why old advice, get a good job, work hard, save money, get out of debt, invest for the long term, and diversify, is bad, both obsolete and flawed advice, Robert has earned a reputation for straight talk, irreverence and courage. Rich Dad Poor Dad ranks as the longest-running bestseller on all 4 of the lists that report to Publishers Weekly, The New York Times, Business Week, The Wall Street Journal and USA Today, and has held a top spot on the famed New York Times list for over 5 years. Translated into 51 languages and available in 109 countries, the Rich Dad series has sold over 28 million copies worldwide and has dominated bestsellers lists across Asia, Australia, South America, Mexico and Europe. In 2005, Robert was inducted into the Amazon.com Hall of Fame as one of that bookseller's top 25 authors. There are currently 13 books in the Rich Dad series. Robert writes a monthly column, Why the Rich Are Getting Richer, for Yahoo Finance and a monthly column titled Rich Returns for Entrepreneur magazine. Prior to writing Rich Dad Poor Dad, Robert created the educational board game Cashflow registered trademark symbol 101 to teach individuals the financial and investment strategies that his rich dad spent years teaching him. It was those same strategies that allowed Robert to retire at age 47. Today there are more than 3,300 Cashflow clubs, game groups independent of the Rich Dad Company, in cities throughout the world. Born and raised in Hawaii, Robert Kiyosaki is a 4th-generation Japanese-American. After graduating from college in New York, Robert joined the Marine Corps and served in Vietnam as an officer and helicopter gunship pilot. Following the war, Robert went to work in sales for the Xerox Corporation and, in 1977, started a company that brought the first nylon and Velcro surfer wallets to market. He founded an international education company in 1985 that taught business and investing to tens of thousands of students throughout the world. In 1994 Robert sold his business and, through his investments, was able to retire at the age of 47. During his short-lived retirement he wrote Rich Dad Poor Dad. In Robert's words, we go to school to learn to work hard for money. I write books and create products that teach people how to have money work hard for them.